All right, boys. I mean, we thought yesterday sucked. Today might suck worse, but let's hold out. Let's let's pretend like there's a chance. Let's pretend that there's no way but up. Oh, for the love of Jesus. It's not good, guys. Not like, do not be fooled by seeing that the Dow had an all-time high yesterday. 35,000. I mean, of course, we close at an all-time high, but it hit an all-time high of 35,000. Like, do not be fooled. Like, it's a bloodbath out there, guys. Especially at the night, which is where the majority of retail investments are in tech stocks right now. I mean, luckily, there's like a couple of things that are uh, rotated out. Yeah, luckily. But right now, even the rotated out stocks, you know, cruise and airlines, banking, and everything. So uh, the only things I have up, I'm hoping there's a sliver of hope here that since these meme stocks are completely detached from the fundamentals of the stock market, that there's a slight chance that AMC continues to go up for reasons I don't think make any sense. AMC is up today. Um, I'll allow it. So here's what I want to do. Ethereum's actually holding okay. I mean, not doing great, but holding okay. But we're going to put AMC on top. And we're going to go to the 1 minute. So last night, late in the evening, it started rising out of nowhere, and then just for some crazy reason in the evening, it just took a rocket ship from 990 to 1089. I had no idea why. But what I think that did is set some sort of precedence that there's someone's out there valuing it at 10 something or 11. Um, it trickled down. I think that might be why the futures were so high this morning, and it's out of being up nearly 5%. Uh, maybe. So I'm gonna just expand the chart right here and watch it. You can see over there it's continuing to rise at 5.13% now to 1024. I would if we can at least get something. AMC saving us. I mean, today's gonna suck, guys. I mean, there's an outside chance that today may be one of those days where it starts out super low and then trends up, right? I mean, we've had days that start really high and then morning they just they trend down and it ends up being the worst day ever. Um, but today, hopefully, is not going to be that day. There's a slight glimmer of hope there. I mean, I think one thing to look at to notice is Zoom. So Zoom closed yesterday at 288, something like that. And we'll look at the chart here real quick. I've been watching Zoom all morning, pre-market. I'm putting Zoom right here on the left. I mean, it's been trending down for a while. Of course, I've been regretting not selling it after the earnings call last quarter. But here's what it's doing. Like this is where it closed, and this has been its after hours. Like it's just put in the tank, all the way to 270. At the opening bell, it opened at about 273, about there. And it's actually shot up since. I'm not honestly sure, but I'll take it. I really will. I hope that it continues to go up. I think that's an indication that we may be wishing to dig our way out of this hole today. Looks like Twilio is doing the same thing. GameStop, TWLO. Twilio is kind of in that same boat with Zoom, and look at it, where it's just people are pretending these are stay-at-home stocks when they're really not. But the world we live in right now. It's TQQQ, not as dramatic. Um, they bounced back this morning. Look at Teledoc is on that. Look at Teledocs. It's kind of the same thing there. Zoom these in so you can see the detail a little bit better. Okay, here's the good news. There might be there's a slight resemblance of the market out there saying, "Hey guys, we've had enough. Uh, Yesterday was a bloodbath. This whole month has been a bloodbath. We've been a bloodbath since early March, and now we've hit our bottom. We need to push it around." I'm not sure if that's what's actually going to happen. Could be fantastic, I suppose. We'll see. I actually have a profitable stock. I put a limit order in at 2601 for DRIV. DRIV, I'm going to put in the bottom two real quick. DRIV is a crap, not just DRIV, not that. There we go. DRIV is an ETF for autonomous electric vehicles. And I think that the future they put in a really low, I think it was 2601, much higher than that, not too far. Let's see, 20-day high is at 28. Its 180-day high is at 9. So it's I think in the middle of 26, which is not crazy low, but not high. Only 5 shares, and so it pre-market this morning took the sale at 2601, and now it's up from there, which is good. That's awesome. I'll take it. Took the order right there. It bounced. It continued to go down, and now it's bouncing. But man, what a morning so far. Now we're seeing a little bit of a leveling off of these three guys right here. Seeing a leveling off here of AMC right there. Let's see what we're looking at here on my portfolio. Pre-market it was down like 3.5% last month, one, maybe 2%. No, less than that. Maybe 1.5. I'm trying to do the math in my head. It doesn't just give me a percentage right here. Affirm is down 12%. Geez, that was a early post IPO investment. I honestly do regret. I did not expect it to tank like it has. But it's down to $50 a share. Even though yesterday, I think after they posted earnings, it was at 8. Yesterday was my first look. I had one yesterday, posted earnings, and it was not bad from what I understand. But man, price target cut was 77 from 160 cut to 67 from 92, 87 from 55. I'd say it's outperformed rating, but that is um, that's weird. I mean, they're saying that outperform rating, but are lowering estimates. I mean, it beat EPS, it beat revenue, uh, beat estimates, but it now it's tanking. So we'll see. I mean, it's a little interesting. It's probably really dropping because of the analyst estimates. It drops the rating, but not so much just on the earnings. Analyst estimates for dropping the ratings due to the earnings. So I'm imagining they know what they're doing much more than I would. So that's a huge number. I bought it at $112 a share, guys. Jesus. And it wasn't at like the height of that stock. It was a little after IPO. I don't think it was on IPO day when I bought it. And then it surged up to 146 back in late February. And yeah, then it just took a dump like I mean, a firm is real. It's kind of a tech stock, but it's kind of not. Honestly, it's kind of a it's really yeah. I mean, it's really not a tech stock. It argue it's a treasury stock. It's about 5 shares. It's only it was like $500 something worth worth of a purchase. But well, hey, good news, guys. We're continuing to fight back. As you can see, the stock's there at the bottom. We have a lot of left used to fight back. zoom to really like Teladoc there on the bottom. We have AMC on the top. AMC is really the shining star today, but we're seeing Twilio is actually positive now for the day, which is just insane considering where it's opened up. It's up, what, 18 points from its pre-market low. Zoom's up 13 points. It's still down 1.5%, but was a lot worse. Teladoc was at 1.8%. So we might have an opportunity, guys, to turn this baby back. That would just be absolutely incredible. I was not expecting that. I was expecting today to be similar to yesterday, where it just continues to just be a bloodbath. I am so excited because we need a recovery day for sure after the way this month started in tech stocks. I guess we had a recovery day on Friday. It was Friday or Thursday, one of those days we had a good recovery day. Yeah, Amazon was starting yesterday. It's bouncing a little bit today. Amazon was doing really good just not that long ago, what, last week? And back, was that right after its earnings report? 36, 3,600 pretty easily, which was an all-time high for the stock, and then it just is tanks. It's then down to 30. So it's crazy how big a stock like that swings so fast. And when it gains, it doesn't gain for crap, but when it goes, when it tanks pretty easily. Let's see what else is worth calling out today. Asana down 6%. AXDX, which is one of the meme stocks, one of the under known, lesser known meme stock from Reddit or Wall Street Bets, AXDX, which is, I don't even know the name of this company, Accelerate Analytics. It is up about 1%, but still down 50% overall. Chewy's up slightly, so that's good. DoorDash down 3.5. Energy transfer down nearly 3. It's interesting to see how that reacts from the Colonial Pipeline deal. FTCB, which is eToro's 4%, which kind of makes me wonder what's Coinbase is up to. Down a little bit. Coinbase actually had a pretty good day. Its shares up 11%, which was fantastic. GameStop down 2.3. Of course, I'm not in GameStop right now. Kodak up slightly. Cost was up slightly, and now it's down. Lemonade down 2.5. Mac, another old, also known meme stock, 6.5%. Netflix is up. That's good news. 0.44%. Norwegian is down. Okta is down slightly. Nvidia is down 2. Nokia is down 2.7. Neo is down 1.46. Palantir is leading the way today up 5%. Yes, ma'am.
So they have the one I found the like cabinet holders and because
Mhm.
this is the one that does I don't know if that's really going on price. But anyway, I don't know. That one's you know that's more than right now.
Mhm.
Is it that much better?
I wouldn't argue it's better. Most practice made by Ford comes with
They're the
so
same exact they're the same dimension. Um and then
that's a pretty
it's not conservative market.
good. You're not either way for the so if you want to get the motor craft, that it's the same that comes with it, that's fine. But if
What do you think of the is better than the brand?
I don't know if it's better, but just knowing that it's the same one that came with it.
Yeah, okay.
Oh, No, I don't think they would do that, but it's just, sometimes the motor stuff for like the Delco and GM, those things are usually more, heavily tested and engineered, so they're not going to have a lot of performance, but they might have lots. So that's one thing I think.
This my friend said 12 months actually from time.
I mean, you might look at it and just go.
Keep it safe. This is the exact one I said in my book. So
Yeah.
yeah, I've been told this more than
Ay, 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 boys. All right. Let's look at, while they're at commercial break here, let's look at the crypto prices. They were not too hot this morning either. Crude oil is down surprisingly. I figured again with this colonial fiasco, crude trading prices would go up a little bit. But yeah, Bitcoin is down slightly from yesterday. Ethereum down slightly, still at 3,900. Dogecoin holding at 49. Litecoin 360. Ripple at 1.423. So not terrible numbers on the crypto market. Let's see if any of the derivatives of Bitcoin or Ethereum are doing well. Actually, yeah, I mean, I think we're seeing a little more movement from Bitcoin SV and Bitcoin Cash. Both of them are up about 5% each, so that's interesting. ETC Ethereum Classic is the one down on Robinhood right now, but not down by much, down 1%. So I think we might, we had a not too hot last 2 days for crypto after the whole SNL situation. I think made a kind of a phony boost and rise in expectation of the crypto market, but not a great day yesterday, and then not a great day today. So, well, they're probably going to come back here. We're watching the Dogecoin and the SafeMoon prices right there on the bottom screen. Let's see what SafeMoon is at. SafeMoon's at 96. I mean, SafeMoon's doing okay. You can see, I mean, it's nowhere near where it was in that big spike, 3-4 weeks ago, but it's coming back, and it was fighting resistance at about 0.5, 0.4. I'm gonna say 0.5, 0.4, even though there's many places before that decimal, and then it went up from 4 to 9, and it's been hovering at 9. Went over 10 just briefly a couple of times, but it's hovering around 9, which is fantastic, which is a good profitable number for me. I'll go to the 7-day chart, so it's a little more sense. So you can kind of see where we're going. Look, they're tracking the S&P heat map there. S&P's down 1%. Man, I mean, that's crazy. Out of 500 stocks here, see 50 that are green. I think a little 5-second come back from commercial break and go to another commercial. These hooks to keep you going for a longer commercial break. But anyway, so we're seeing SafeMoon up right now, which is fantastic. To me, I'm in SafeMoon just for the 10x pop. I think there's a chance we get in crazy hold. What I like about SafeMoon is its holding incentive that people sell, then a portion of their sold tokens gets redistributed amongst the rest of the holders. And so I've made just holding for the last month, somewhere in the ballpark of 100,000 safe moon tokens, which is not much, right? Let's say 100,000 safe moon tokens times 0.00000, no, four zeros and a one. Let's say that's almost X. It's at 996. That's $1. My 100,000 free tokens is only worth $1, but it's still it's still interesting to really see. And I think the more that we see it spike and dip, the more volatility there's, the more volume there's going to be, which means the more we're going to come back. And I mean, or more money is going to get redistributed back to the holders. And so, hey, why not? I mean, you just keep it there, earn $1 a month or more. Yeah, why not? In addition to obviously the price going up. Where are we at on these guys? Twilio and Teladoc still going up slightly. It looks like Zoom is leveling off a little bit. Portfolio, brokerage portfolios, man, it's coming back. It's gone from down over 3% down to a 1.5%. Roku's positive now, Ring Central's positive, Stitch Fix is positive, Twilio's positive, Teladoc's now positive. It just clicked over. So, I mean, we're looking at Wayfair's now positive. So, a lot of these, what you would call stay at home stocks, which were bloodbathing earlier, are now positive. Tesla, look at Tesla. Let's do this. Let's put Tesla in the bottom left. I considered buying one more share of Tesla early this morning because look at what it got down to 578. 578, which is the lowest it's been in a very, very long. I mean, remember 590, 595 a month and a half ago when I was telling you guys how good of an opportunity it was to buy the dip. It hit 579 first thing this morning, pre-market, and now it's back up to 621 and surging. The six Tesla is probably going to be positive here pretty soon. Roku now 2%, still going. Netflix at 1%. Kodak and cost Facet at nearly 3%. AMC staying on top of the bond now, only at 4%, but still doing well. And look at that, my portfolio is now up to about only down 1%. Man, we are turning this baby around. How exciting. I did not honestly expect that, but I am excited about that. Yeah, NASDAQ has gone up 1.2% since its low, since its opening low. Its pre-market low was even worse than its futures. And I mean, basically everything that started down 2, 3% is shipping up. Is that a verb? Rocket shipping? We're gonna call it a verb. It's a really good name for a verb. Not for sure is that, but it's like at 4 this morning. Man, lowest since January, since the pre Coinbase fiasco. Same with Riot. 25 since early February for Riot blockchain. Hey, lumber's leveling. By leveling, I mean it's $1,600. Let's go, baby. Let's go. Let's go. Let's go. This is exciting. This might be the best stock market day in a long time. Oh, Jesus Christ. This is crazy. So let's do this. I'm going to shut up, get some work done. You guys can watch these stocks. Again, we're not really watching crypto today because crypto is just kind of doing its thing, nothing crazy. Look at that GameStop up in the top left. I got the news. GameStop's up 1.5, 1.2%. That's there you go. We are seeing potentially the great turnaround. We could go from a down 3% to up 1 or 2%, and I mean, man, that could be like the greatest pre-market to peak turnaround I've seen in a very long time. If we can turn that baby around, let's do it, man. We're almost back to at least my portfolios being positive again. I think we're still a stretch away from the actual uh, um, index is going positive, but they are at least trending that direction. So super excited about that. So let's. I'm gonna shut up for a little while, get some work done. I'll turn it over to the news. CNBC should be back any second now. Of course, their morning and their afternoon coverage, they do nothing but commercials, and it kind of ticks me off. But here we are. So I'm gonna turn this off. They'll be back any second now.
Good Tuesday morning. Welcome to another hour of Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan, who's back, and David Faber. Markets with a little more weakness after Monday's tough session for tech, but off the initial lows. NASDAQ was down more than 2% at the open, currently down 0.7. Jolts out a few moments ago. Let's get to Rick Santelli.
All right, I'll tell you, folks, you're going to get a jolt out of jolts. Job openings and labor turnover surpassed the 7.5 million job openings and crashed through 8 million. 8,123,000. Wow, this is huge. All these job openings, and the debate rages on as to exactly why we're not filling them, whether it's skills, whether it's benefits, whether it's fear of COVID, whether it's childcare and school issues. I can't tell you the percentages of each, but I can tell you for sure it's part of all those, and this number is certainly going to incite people to continue to kick the tires on some of the stimulative policies, whether the Fed or Uncle Sam, because 8,123,000 openings is a lot of potential jobs for people to take. Morgan, back to you.
Yeah, and certainly interesting to see a number like that after Stanley Druckenmiller's comments this morning on our air, too. Rick Santelli, thank you. We're 30 minutes into the trading session. Here are the three big movers we are watching, starting with Virgin Galactic, well off its lows, still down about 7.5%, though, after reporting a loss that was more than double what the street was anticipating. The big focus, though, Richard Branson's spaceflight company also saying it's evaluating the timeline for its next test flight, citing the need to analyze wear and tear issues for its mothership, which is what launches the rocket to the edge of space. Meantime, Palantir reversing course after starting the morning lower. It is now up 5%. Earnings matched, revenue beat. The company says it expects annual revenue growth of 30% or more through 2025. And finally, L Brands deciding to spin off its Victoria's Secret operation rather than sell it. The company will split into two separate public companies, Victoria's Secret and Bath and Body Works. Those shares, though, are under pressure, down almost 3%, David.
After an incredible years-long run. Thank you, Morgan. Let's get over to Mike Santoli now with more on what is continuing pressure on big tech, Mike, although we are, to put it mildly, well off the lows at this point, starting to see some green out there.
Yeah, David, pre-market panics sometimes get bought, at least in the morning. Still plenty of time left in the day to see how this all shakes out. But really, I think mostly you can characterize what's been going on for a while as just this very choppy transition from
secular growth tech into more cyclical areas. You look at the S&P 500 since the end of the first quarter, it gives you a gauge on just what the downside has been in March and April and May. Down 4120 is basically the line that separates routine pullback from something that's potentially a little bit deeper. We're not near there. We were around 4130 at the low last week. So that just tells you, for the moment anyway, it's contained. Look at the Dow versus the NASDAQ. This really tells the entire story. The Dow obviously more cyclically geared, the NASDAQ diverging to the downside. How much can we get stretched on this front? Very difficult to say. It seems like a lot of this has already been in train for months at this point. And then a sort of more focused version of that is semiconductors against industrials. Also, quarter to date, semiconductors really have given up their leadership role in this market that sometimes is going to be at least a kind of a yellow flag, if not a red flag on the rally. So, you know, it's a sort of an arrhythmia right now that the market is going through, I would argue. And, you know, you're asking 30% of the S&P, right, industrials, financials, parts of consumer discretionary, materials, and energy, to do the work for the rest of the market when you have another 40%, tech, communication services, and Amazon have been heavily for sale. So I think that's why you have a lot of the unease in the overall market, even as the macro message of the market seems to be pretty good, guys.
And Amazon, I like that, Mike.
Yeah.
But, you know, speaking of Amazon, it's more or less, let's call it flat on the session right now. I mean, are there any tells for you when you take a look at this market in terms of trying to understand when, at least short term, there may have been maybe a bottom for some of these big tech growth names?
Well, Amazon, interestingly, yesterday again went down to just a little bit through its 200-day average. It's acted awful. I mean, for one of the best quarters any company ever put up in terms of top-line growth on a massive base. And I do think part of people are saying, look, Bezos is leaning on this stock. You see how he's, you know, selling it. And it seems like it's kind of a, what can you possibly do as a follow-up act to what they've already done? All that stuff. So I think Amazon could be a cue because it's been weak for a while. And then in general, semis, and see if they get some kind of a bid in here, because that seems to be both a risk appetite tell and a macro indicator.
Mike, thanks for that. Obviously, so much to watch on a pretty interesting open, as we figured it would be a little dramatic given the pre-market. Mike Santoli. Let's continue that conversation with Lou Piantadosi, Eaton Vance Management Vice President and Co-Director of Growth Equity, joins us this morning. Lou, it's a good day to have you. Thank you for the time.
Good morning, Carl. Thanks for having me.
I was just looking at a note here from Morgan Stanley. They say that their unprofitable tech basket, and everybody's sort of got a version of that, has underperformed SPX by 42% over 3 months. And if you take out COVID last spring, it's the worst stretch in 10 years for any thematic basket. And they looked at over 100. I guess at this point, do you think that's getting a little tired?
I think that the sell-off is justified given the meteoric rise that a lot of these stocks exhibited, particularly post the COVID, initial stages of COVID. And, you know, given where we are right now, I mean, there's 4 real headwinds to most areas of tech, and namely the fear of higher rates, tougher comparisons going forward, particularly to those that have benefited from COVID, corporate tax reform, which is something that isn't being discussed right now, but it will have an impact on tech more so than other areas of the market. And then lastly, particularly for mega cap tech, I think, you know, we're seeing more and more antitrust headwinds starting to pick up as well. So all of those headwinds, you know, kind of come together at a time when there's other areas of the market that will benefit from a recovering economy that had been neglected by the market for the last few years. And now we're starting to see a real resurgence. So really no surprise here.
It does sound like you think there are areas within tech that are viable on a pullback. And I think you're pointing to semis on that. Versus others like payments and cloud, where maybe the high valuation means there is a little more downside to come.
Yeah, I think that's exactly right. I think the semis are viable right now. I think the stocks have come in, not as much as some of the others, but the valuation of those companies are much more attractive for kind of a good entry point in some of those names. I like the analog semis the best because they do have leverage to a recovery of the industrial economy. You know, areas like payments, AI, the cloud, still great long-term secular growth opportunities. But I don't think those names truly bottom out until investors can kind of figure out well, where are rates going? Where is this inflationary environment we're in? Is that transitory, or is it going to be something that's longer lasting? And if it is in fact transitory, and rates go to 10-year goes to 2% and change, those stocks will be close to bottoming out here. But if it's something more difficult than that, then we might have a little bit more to go before those do bottom out.
Lou, it's Morgan. Just in terms of being able to gauge a bottom, or I guess factor in some of the signals that might indicate we're there, is this just a matter of giving time when you talk about the possible transitory nature of the situation, or are there certain actual things that you're looking for right now?
Yeah, I think for us, the biggest things on a fundamental basis is we're likely to see a real deceleration of growth in a lot of those names, particularly the ones that did benefit from the COVID shutdown. And, in the growth stock world, nobody likes to see a deceleration. But given that, we had kind of where we borrowed some business from the future because of COVID, we're going to see that natural deceleration. But the market still hasn't really come to grips with how much of a deceleration are we going to see. So I think once the bar gets reset, and I think it's coming in the next quarter or two, we'll get a better picture of what is truly the long-term sustainable growth rate for these names. And once the market gets comfortable with that, these names probably become investable again.
So does that mean that at least for now, for the next couple quarters, value is the new momentum play?
Well, I mean, it has been for the last 3 or 4 months, right? And again, I think that's it's been a neglected area of the market for a long, long time. And, money goes where it's treated best. And right now it's being treated best in those stocks. And I think that, but at some point it does create an opportunity for long-term investors. And, I don't think we're exactly there yet. Like I said, I think the semis are certainly viable here. But for new money, I think there's a little bit more to go in some of these areas that are a little bit growthier and more expensive.
So does that mean, Lou, that if you get new money in, you're actually going to take the plunge into some names? I mean, how are you reallocating within the portfolio at this point, given the things that you're outlining?
Yeah, that's a good point. Like I said, we're certainly more inclined towards those levered to a rebounding economy. And like I said, the semis certainly qualify for that. We have a valuation sensitivity to everything we do. We're more of a GARP style than a momentum style. But again, we're looking at a lot of areas that have these secular growth characteristics that as they come into attractive prices, we're buying a little bit here, there, 10, 20 basis points. I mean, some of these names are down 40, 50, 60%. So to say that we're still early in the decline, I think would be disingenuous. I think there's probably a little bit more to go. And as you start to scale in bit by bit, not a bad strategy for the next few months.
I guess the question would be, Lou, if you did get a further downdraft on some of those areas, whether or not it would make investors even more uncomfortable and crashing into so-called cyclical names, or whether there is still a mentality that price brings interest, brings bargains, and there would be a buy the dip mentality. It doesn't sound like you think that's dead.
Yeah, no, I don't. I mean, it's very hard to gauge where, kind of the momentum is, or where the retail investor is going to go. We've seen a big correction in a lot of these retail favorites. And, I feel like that's kind of the point of we've got to make a decision on these stocks. Do we want to stay with them, or is it a buy the dip mentality? And I think retail investors have been getting their hands slapped whenever they do try to buy the dip over the last few months. So, flows are difficult to gauge, but at the end of the day, we're looking at the fundamental value of the business and what we think it is relative to what the market's telling us. So if we're a little bit early, that's okay. If there's a little bit more downside that gets overdone, we're okay with that too. And that's why we kind of ease in along the way during some of these big time corrections. We wait for the market to come to our terms. And, when the market's fearful, that's typically the time when, you want to get a little bit more aggressive, right?
Yeah, well, anyone who's been around for the past 15 months can attest to that. Lou, that's a great gut check, especially on a morning like this. Thanks so much.
Great. Thank you for having me. I appreciate it.
As we head into a quick break, here is a look at our roadmap for the rest of the hour. Shares of Virgin Galactic well off the lows of the morning. Future test flight facing potential delays. We're going to dig deeper into the numbers and the outlook for the broader space sector.
Plus, Ginkgo Bioworks going public via SPAC at a $15 billion valuation. We'll talk to the CEO later this hour.
And new developments in the Colonial Pipeline ransomware attack. We're going to give you those details. Squawk on the Street is coming right back.
Well, it looks like we've unfortunately given back some of the attempted gains this morning. As you can see there, Tesla's starting to turn back downward. So is Twilio. Teladoc a little bit there just in the last few minutes, and Zoom has been kind of leveling off for a while there, but still trending positively. So, and then you'll see AMC is giving back some of its gains as well. GameStop up here in the top left was positive for a very brief moment. It's now down 2.6. So might have been a short-lived rally, or this just might be a little bit of a mid-morning lull, and the mid-morning lull is happening earlier than expected. That would be the best case scenario. We're seeing the Nasdaq down 1.22%. It was up to down 0.69% at one point. So it's given back quite a bit, but still 1% higher than it opened the day, if that's any silver lining right now.
Welcome back. It is now time for our ETF Spotlight. We're taking a look at the S&P Aerospace and Defense ETF, ticker XAR. It's now negative over the past month of trading. Still positive on the year, down about 1.5% right now, propelled by strong performances, the strength of this year, I should say, from top holdings like Textron and more pure play defense heavyweights Northrop Grumman and Lockheed Martin, but also a holding in the fund, Virgin Galactic. It's well off the lows of the morning. It's still down 8%, though. Richard Branson's space tourism company reporting earnings results last night that once again included no revenue and a loss for the quarter. The big news, though, is that there is no date set for its next crewed flight, which had been planned for this month due to an unexpected possible maintenance issue with the company's carrier aircraft. That flight is to be the first of 4 tests before commercial service can actually begin. You couple that with significant insider selling in recent weeks. Also the news that competitor Blue Origin will take its first paying passenger to the edge of space this summer. Shares have been falling back to earth. They're now down almost 70% from the February high. And as I mentioned, you can see under pressure again today. So for more on the commercial space sector more broadly, Jared Isaacman, the billionaire founder and CEO of payment processor Shift4 Payments, joins us now. He is the benefactor and commander of the first all-civilian Inspiration 4 mission to orbit via SpaceX, which is set to launch as soon as September. Jared, great to have you back.
Great to be back. Thanks for having me.
So we have a lot to get to, including the fact that you have been doing training with SpaceX this week. But first, just given the fact that space from an investor standpoint is so in focus right now, I wonder how you see this inflection point for this commercially driven era of human space flight more broadly. How crucial you think it is for all of these companies, whether it is Virgin Galactic, whether it is Blue Origin, whether it is SpaceX, which is really the leader in the sector and is the one that you're working with right now to succeed. And I say that not just from a safety perspective, which is obviously paramount, but also from a financial one.
Yeah, so we're certainly at an interesting time in commercial space exploration. I think this is like the great, the second great, space age underway right now. And every mission that gets launched, whether it's suborbital, in the case of like Blue Origin or Virgin Galactic, or orbital in the case of, SpaceX, is a pretty special one. That said, and obviously I root for the home team here, very hard to bet against Elon or SpaceX right now. I mean, if you look at just the reusable rocket technology that they've been, perfecting over the last, 6-7 years, has been a key driver in making space more affordable and therefore more accessible, whether that's for crewed or, human spaceflight missions, or simply creating, massive constellations of satellites to bring, broadband connectivity to some of the, hardest reaches and farthest reach places of the Earth. So pretty impressive what they're doing at SpaceX, but exciting to see everything as a whole in the commercial space industry.
As potential space tourists decide where they might book their flights, given all the developments among these different companies, I wonder how and why you decided to go with SpaceX and sort of skip the suborbital piece of the puzzle altogether and just go straight to a multi-day trip around the Earth.
Yeah, so the opening disclaimer is I'm really obviously a big SpaceX fanboy here. So I think it's one of the most well-run companies in the world. What they do on a daily basis is extraordinary. And I think you have to appreciate just the huge, technological leap there is from suborbital spaceflight to orbital. Suborbital spaceflight, you're putting something up and it absolutely will come down very, very quickly. Versus you put something up in orbital space, it's going to stay there for a very, very long time until you bring it back. SpaceX has been doing that for a really long time and, efficiently reusing their boosters, which again is critical to making space more affordable and accessible for everyone. To me, there's no contest. The only reason human spaceflight exists in the United States right now, since the space shuttle was retired, is because of SpaceX and the contributions from NASA.
I would imagine you have some unique insights in the sense that you are, working to go to space right now with SpaceX, but also you are the billionaire founder and CEO of a tech company that went public less than a year ago right now, and know what it is to adjust to quarterly reports and deal with public market investors. How do you see space companies like, for example, Virgin Galactic navigating that, and what investors need to understand about the sector?
That's a really excellent question, right? And as the CEO of a public company, I mean, we talk about our TAM a lot. What is the total addressable market? What is our opportunity, and our points of difference in the market? And I'd say that those that are focusing on suborbital spaceflight have a challenge ahead of them, right? I mean, how many one-time suborbital spaceflight experiences, whether it's 250,000 or 500,000, can you do? And even if you kind of perfect suborbital point-to-point transportation, going to New York, to Australia in like 20 minutes or something like that, on a rocket, it's very expensive. I don't know if that'll ever really be affordable to that extent. Versus you look at orbital, that has a lot of utility, right? I mean, not just, human spaceflight exploration like what, SpaceX is doing with NASA or Inspiration 4, but also payload, putting cargo on the space station, putting satellite constellations up that have real commercial intent. So I think the TAM and therefore the opportunity associated with some of the, players that are focusing on orbital spaceflight, SpaceX, Rocket Labs, totally different than those that are focusing on suborbital, which I think is a little harder.
Yeah. I'm curious, given the fact that you are continuing training for Inspiration 4 right now, how you're managing that versus your day job at Shift 4 right now, especially given the fact that Shift 4 just on the heels of earnings last week is continuing to make acquisitions, strategic investments, and expand not only into restaurants and retail and hotels, these areas where you've been doing payments processing, but also things like stadiums, sports betting, et cetera.
Yeah, so I mean, I love my day job, and nothing's changing about that. I mean, we did just come off reporting earnings last week. We're a payments company that focuses on restaurants and hotels, and we grew during the pandemic. We reported Q1 up 30%. We raised our guidance where we're projecting annual payment volume in 2021 to be up 85% year over year. So we're doing really well. We have a value prop that wins in the best and worst of economic times. So totally excited about my day job. The answer is really, I'm just not sleeping a whole lot. I can deal with that after I come back from space. So training on nights and weekends, focusing on shift 4 during the day.
All right, we're going to leave the conversation there, but great to speak with you today, Jared. Thanks for joining us. Jared Isaacman.
Hey, thanks for having me.
As we go to break, one tech name that's still in sell-off mode is Rackspace, down 20%, despite its earnings outlook coming in slightly below expectations. With today's move, the stock has given up nearly all of its gains for the year. There's more ahead, with the Dow down more than 1%, worst day since February 26. Don't go away.
All right, take a look at the markets. After an open that was down sharply and then a rebound in the first, let's call it 40 minutes of trading, we are back towards the lows, as you can see, with the S&P and the NASDAQ and the Dow all down a similar, let's call it 1.3% at this almost 10:30 hour, about an hour into the trading session. A ton of new developments on the Colonial Pipeline ransomware attack. In the last hour, the EPA says it's going to be waiving some gas mandates. That would be to address the current fuel shortages. Eamon Javers joins us with more on the attack itself. Eamon.
David, a ton of new developments here, a ton of statements from the entities involved. We even got a statement yesterday from DarkSide, which is the bad guy group in all of this. But what we don't have is an answer to the central question, which is Colonial Pipeline going to pay this ransom or not? Or have they already paid the ransom? total radio silence on that question. And it's a hot button issue inside the cybersecurity community. We saw yesterday the U.S. government taking the unusual step of saying they're going to take a hands-off approach on this. They're not giving Colonial Pipeline any advice on whether or not to pay or not to pay the ransom. They understand that this is a tricky situation. I talked to Lior Div yesterday. He's a CEO of a firm called Cyber Reason, a cybersecurity firm. He's in Tel Aviv. And he gave me his analysis of why this is such a tricky problem for companies when they're weighing whether or not to pay. Here's what he said.
My recommendation, usually in most of the cases, it's not to pay those groups, because eventually they're going to take this money and they're not just use it as a profit. They're going to use it in order to become better at what they're doing, and they're going to keep hacking. So by doing it, basically we're funding their operation and enable them to basically keep hacking.
And the other question here is, who is this group DarkSide? We saw this statement from them yesterday expressing sort of remorse. It was an odd statement in which they promised to change their ways here. I've been talking to other cybersecurity experts on this group today. One of the pieces of analysis I just got from Karim Hijazi, who's the CEO of Prevailion, he told me that his guess is that this is a group that has former Russian government employees on the payroll. And the reason is because of just how quickly and how effectively they set up. They came out of nowhere in August of 2020, set up operationally very quick, very effective way of hacking into all of these companies around the world out of nowhere. That lends a lot of people, including Kareem, to suspect that there might be former Russian intelligence or Russian government people involved in this criminal gang, but no one really knows for sure. And so there's a lot of questions here that we're still trying to get some answers to, guys.
Yeah, well, aim it on that. I mean, what are your expectations, given you've been on this beat for quite some time, that we will actually get some answers? Because it feels like we go from one to the next, and it's never completely clear what just happened because we're dealing with what is happening.
Yeah, and it's never completely clear because the companies don't want you to know, right? I mean, the companies don't want to admit that they're paying these ransoms. And we know that they are. We don't necessarily know which companies are paying which ransoms, but we do know that a lot of money is changing hands from corporate America straight to criminal gangs, and a lot of them in the former Soviet republics. And the question is, who's paying who? The companies, have an interest in letting these things drop out of the news cycle and just simply quietly pay and move on. You heard from Lior there, who says his advice is don't pay because they're going to take your money and they're going to use it to finance their next attack on somebody else. But each individual company, inside that boardroom is making a decision of whether or not they need to save their company, and they're not really thinking about the next hack. They're focused on the very short, immediate term, which is how do we save our company here from going out of business?
Yeah, it's a tricky one. And you think those lack of disclosures or lack of a pool of that information about these attacks is only hindering the process of being able to create more robust national and corporate defenses against future attacks as well. Eamon Javers, thanks for bringing us the latest. After the break, Ginkgo Bioworks going public in a $15 billion SPAC deal. The CEO is going to join us next. We're back in 2.
Solomon, and here is your CNBC COVID update at this hour. The director of the National Institutes of Health, Dr. Francis Collins, telling CNBC that the FDA's emergency use authorization of Pfizer's COVID-19 vaccine in kids ages 12 to 15 is a big deal.
Adolescents have been taken out of social circles, out of school sports programs, out of going to the prom, out of hanging with their friends. This is a way to get us back to normal and well in advance of getting the school season started in the fall.
Novavax again delaying its timeline for seeking regulatory approval for its COVID-19 vaccine. The drug maker says that it does not expect to seek regulatory approval in the U.S., Britain, and Europe until the third quarter of this year. And hundreds of people crowding a hospital in southern India to try and secure a drug used for COVID-19 treatment. India's been facing a shortage of medical supplies amid its COVID crisis, but the crisis showing a sign of easing today with the number of cases there declining. You're now up to date. Morgan, I'll send it back to you.
Rahel Solomon, thank you. We're about an hour into the trading session. Let's take a look at the biggest leaders on the Dow right now. We actually only have three components that are in the green. Healthcare names Merck and Amgen and P&G. Everything else is lower right now in terms of what's leading the losses. It's names like Home Depot, Boeing, and Apple. David.
Yeah, well, the stocks of companies we call cloud companies are at 6-month lows. Rotation, of course, out of technology overall continues to accelerate. Josh Lipton has more for us. Josh.
So, David, that rotation out of tech we know has been hitting those high-flying cloud names as investors now looking to sell last year's top performers. So check out the CLOU. That's an ETF that tracks the cloud names. It's looking to avoid its 8th day of losses in the last 9 sessions. It's now down about 20% over the past 3 months, and that, of course, vastly underperforming both the tech sector and the broad market. Fund flows into that ETF increased by $600 million last year, but have now declined by $112 million this year through April. Notable laggards include names that ripped higher last year as we all looked for the products and the tools that would help us learn and work remotely. So video chat with Zoom and text communications with Twilio. Recent tech IPOs are also taking it on the chin. Check out names like Snowflake and Unity and Asana, all down hard from their recent highs. Palantir, though, actually is a bright spot, now in the green here. Still, though, it's down about 20% just this month. It's down about 60% from its all-time high. Just this morning, Palantir reporting and beating expectations on the top line. Better than expected Q2 revenue guidance as well. Brent Till over at Jefferies says it was a strong report in his opinion, but the street had actually wanted to see even more upside, he says. And Brent does emphasize that Palantir is certainly a unique asset, but it is a pricey one. And that combination, he says, is going to be a tough one in this environment. Carl, back to you.
Josh, it's a great point. It's a big name to watch, along with a bunch of names in fintech and crypto. And for that, we're going to turn to our Kate Rooney. Hi, Kate.
Hey, Carl, these payments and high-growth tech names had been some of the biggest winners during the pandemic. Those continue to fall out of favor today, though, as part of that shift from growth to value. Let's start with Affirm. The buy now, pay later company down pretty big today. It's down about 7% right now after earnings. They saw a mixed report last night, and despite growing revenue and payments volume double digits, the company's losses were wider than expected. Affirm also reporting a revenue hit from those Peloton tread recalls. Next, Cathie Wood's ARK Innovation ETF. This has really been a barometer for those high-growth tech groups, which is getting hit today as fears of inflation and higher rates creep up. The ETF is down slightly today. Yesterday, the ETF did see its worst performance since March and its 9th negative session out of 10. Meanwhile, Shopify, that's been another huge growth story and a winner during the pandemic. It's down. It was down about 5% today, now down about 3%. Over to those payment names, you've got Square and PayPal, despite some big beats on earnings last week. Both companies down today. Square is down more than 10%. And some of those traditional payments names, Visa, MasterCard, American Express, also taking a hit. Amex is a slight outperformer. It was up this morning, but now it is down almost 3%. A different kind of payments play, meanwhile. Crypto exchange Coinbase also getting hit today. But Cathie Wood's ARK Invest coming in to buy the dip, the actively managed ETF, adding 33,000 shares of Coinbase to that fund. And finally, the broader crypto market also cooling off today. Bitcoin, Ethereum, And Dogecoin also lower as some of the risk appetite in the market simmers down. Carl, back to you.
All right, Kate, thank you very much. A bunch of names to watch. And as we go to break, take a look at semis as well, slipping into correction territory. Shares of AMD and Intel both sharply lower for the month of May. The stocks down more than 10% from the April record. The CEO of IBM joined Squawk earlier this morning. This is what he had to say about this chip shortage as the S&P goes red for the month.
I know we talk about semiconductor shortages, and that's a real problem, not just this year, but probably for a year or two to come. And it's not just automobiles, so that has been talked about a lot. The chip shortage will impact computers, will impact K-12 education with laptops as well as tablets, will impact consumer electronics, health electronics, and so it'll go across the industry. And it is something that the government should take quite seriously.
Which Dow stocks could lead the blue chip index's next leg of the rally? Our traders share their favorites on tradingnation.cnbc.com. More Squawk on the Street coming up.
Welcome back. Just getting a quick check on the markets right now as the selling accelerates this morning. The Dow's down 577 points or 1.6%. Similar move lower for the S&P, which is also down about 1.6%. Worst day for both of those averages since late February. The Nasdaq, meantime, is down about 1.4%. It's now down more than 5% for the month of May, with the S&P also just turning negative a short while ago. Meantime, biotech firm Ginkgo Bioworks announcing this morning that it plans to go public via SPAC merger. It's one of the biggest deals in the space this year. It values the company at more than $15 billion. And here with us now is CEO and co-founder Jason Kelly. Jason, congratulations and thanks for joining us today.
Thanks, Morgan. Happy to be here.
So given the fact that we are seeing this broader downdraft within tech and growth names, not only today, but in recent weeks, not to mention the increased scrutiny by the SEC towards SPACs, why the decision to go public today and why, or to announce to go public and to do so via a SPAC?
Yes, the major reason for us was velocity, right? You know, the doing a IPO process in general, you know, takes your whole executive team out of the game for, 6 months or so. And we wanted to get there faster. We really like the folks at Soaring Eagle. They've been around the block, been doing this for a decade. So we were able to do it real quick. We did a PIPE in about 2 weeks, raised $775 million into that with great investors, Bailey Gifford, Morgan Stanley, ARK, folks like that. And so we're really excited. I think it's a faster way to get back to building the business.
So in terms of the capital you raise, how will you deploy that?
Yeah, so Ginkgo's business is, we program cells kind of like you'd program a computer. Right. So if you've had, an mRNA vaccine, that's a piece of RNA code. It's ATCs and Gs, not zeros and ones, but your cells read it. They make a little protein. They turn your immune system on. Well, what Ginkgo has, here in Boston, about 200,000 square feet facility to read and write that DNA code. And we work with companies, have a $100 million joint venture with Bayer Crop Science. We work with Roche and antibiotics. We did a project with Moderna last March around on the vaccine supply chain side. We're like an AWS for programming biology. And this really feels like the right moment to bring that out in the world. People have biology on the mind.
It's an interesting metaphor, but so I guess really instead of custom software that you're creating for companies, it's really these custom genomes, if you will. How does the actual business model work? How are you making money on this? Is this about specifically the IP? Is it something else?
Yeah, so what we do is we really have two ways of bringing in revenue. One is while we're doing a project for a customer, they pay us on a usage basis. Think like using an Amazon data center. You pay them for compute. You pay us when our robots move to program that cell for you. That's the first way. And then second, when we're done after, say, a 1 to 3 year project, we do a value share, like think like Apple App Store, a reach in to revenue either through a royalty or in lieu of a royalty equity in the company. And so those are the two big revenue streams for us. And today, the majority of our revenues, we're projecting 150 million in revenue in 21, up 95% from last year. That's largely in the foundry revenue coming from usage. But in the future, there's an enormous opportunity for bioengineered cells. McKinsey projects $2 to $4 trillion for cell applications in the future. I think ultimately it'll be bigger than apps and computers.
Jason, you mentioned the 150 million in revenue and your foundry billable revenue for 2021 at about 100 million. You see that increasing tenfold over the next 4 years to, let's call it 1.1 billion by 2025. What gives you the confidence that you can ramp revenues to that extent?
Yeah, so the great thing is the kind of work we do is actually already done out at biotech companies today. It's just done by people with my background. So I did a PhD in MIT in bioengineering. You want to get one of those? It's about 5 years of moving liquids around a lab bench by hand. We take that work and we move it on to robotics, drop the cost with scale. Well, today in that industry, last year, there's a nice Piper report, spent about $33 billion on that kind of work. And so what we're doing is migrating that. Think like going from on-prem servers and IT to cloud. There is that existing spend. So out of that 33 billion, as you're mentioning, only 100 is coming to us right now. So there's a real opportunity for growth there. It's just the first inning.
You mentioned, of course, Soaring Eagle. It's Harry Sloan. They've had a good track record. But I would note the SPAC is trading below 10. There is always the possibility that shareholders reject the deal, or at the very least, it's more than expected sort of redeem, which reduces your overall capital. Is that a concern to you?
Not a concern for me now, no. I mean, we brought in really great folks in the pipe. Obviously, it's a very tough time in the markets at the moment. So I think that's part of what you're seeing. And one of the things I like about it is if you look at who came in, it's all folks that are long-term bets, right, on Ginkgo. And that's how we really see the company. We're trying to build sort of an Amazon scale company over the long term. Those are the people I want on the cap table anyway. I think a lot of that frothiness of people just chasing SPACs to get a quick flip has sort of gone out of the market. And I'm pretty happy to see that, to be honest.
Jason, when you talk about the opportunity here being bigger than apps and computers, I mean, you're involved in fragrance and agriculture, involved in COVID. You're doing tests at schools across the country, as well as we see those begin to open up. Where do you see the greatest opportunity in terms of this technology being applied?
Yeah, it's interesting. It's kind of like trying to predict, where microchips were going to get applied in the 50s, in the long run. I'll say in the near term, really in therapeutics, we see a big opportunity. Ari Beldegren, who is the founder of Kite Pharma, is joining our board as part of the transaction. He's involved with Soaring Eagle. Ari sees a real opportunity for this to be applied in cell and gene therapy and pharma. I agree with that. But in the long run, look, a computer is a machine that is programmable. You put in code, it does new things, but it moves information around. So it disrupted all your information-based industries, media, telecom, finance. Cells are programmable, really they are. You put new DNA code in, they do new things, but they don't move information around. They move atoms around. And so what's going to be disrupted is all the physical goods industries, food, pharma, media, building materials, so on, right? Anything that's made out of stuff in the long run, it's a biotech industry. It just doesn't realize it yet.
Jason Kelly, thanks for joining us today.
Thanks for having me.
Coming up this morning on Tech Check, a lot more on the tech turbulence with all FANG names in the red. And an exclusive with ServiceNow, CEO Bill McDermott begins at 11 a.m. Eastern in just a few moments. In the meantime, worst day now since February 25 for the Dow and the S&P.
Welcome back to Squawk on the Street. I'm Dominic Chu. Stocks are still lower for the day, hovering right near the session lows, with every sector in negative territory in the red, as you can see behind me here. Among the worst performers, though, so far today is the consumer discretionary sector, the third worst performer so far. Now, within that group, we are seeing weakness in the home construction-related names like Lennar, Pulte Group, and Home Depot as well. But the worst performer in the S&P 500 overall today is Hanes Brands, as the company's current quarter and full-year forecast falls short of some analyst estimates. Those shares, you can see, they're down about 14%. Now, Morgan, I will send it back over to you folks at Squawk on the Street.
Tom Chu, thank you. Later today, do not miss a special CNBC event, Healthy Returns. We're bringing together top healthcare CEOs, technologists, and investors to explore how the most innovative companies are addressing the coronavirus crisis and the lasting effects on the industry. Join leaders from Pfizer, Teladoc, Eli Lilly, the CDC, even Blackstone with its big biotech bet. I'll be there too. It's not too late to register. Go to cnbcevents.com/healthyreturns to sign up. We'll be right back.
I don't even understand why they're rooting for inflation. It hurts the poor, it hurts the lower income, and if you bust an asset bubble, I promise you the people are going to get hit the hardest are my kids in Harlem and the lower income brackets, not the wealthy.
That was Stanley Druckenmiller earlier today on Squawk Box. Let's get over to the CME now, and Rick Santelli, who I'm sure has lots of thoughts on that and many other things for the Santelli Exchange. Rick.
Yes, and thank you, David. Sure. Listen, Stan Druckenmiller is one of those traders that just always seems to have the Midas touch. And whether he's 100% correct on everything really isn't the issue. He is highlighting things we need to pay attention to, and especially his last comment. I think many forget that view inflation as a cost of living increase, and believe me, the bottom rung socioeconomically are going to feel the pressure more. And it really does challenge the entire notion that in order to raise the bottom, somehow we need to lower the top. I've never found the logic in that. Now, let's really get to the heart of the matter. At the crux of Stan's argument today and his reason for thinking maybe the Fed's been too aggressive, maybe there's too much sugar out there, the punch bowl's too big, is that the Fed needed to step in. They absolutely needed to step in. The problem is they also needed to step out, to step back. It's the same problem in the credit crisis. Between Bernanke and Janet Yellen, they just didn't step out fast enough. We all understand why. They don't want to do all of this basically move heaven and earth to try to, in their opinion, save the economy or save the global economy and then pull out too early. But the problem is that the residuals of staying too long are not good. You know, servicing the debt and inflation is really the issue here. And Stan brought it out. They might ultimately be forced to monetize. Now, this is going to get in the weeds just a bit. I'll oversimplify. When you issue debt, technically you're not monetizing. You got to pay the debt back. The problem is that when you do QE, if the Fed holds it to maturity and gives the interest to the treasuries, it's the same as monetizing the debt. Because monetizing the debt basically is print, baby, print. It's printing, printing, printing without having an obligation to pay back. And unfortunately, another thing the Fed has done is by artificially creating an interest rate environment that doesn't represent the risks that we face at this point, with so much stimulus coming after the peak of COVID hit, that we can't tell where the risk-reward profile is. And the TINA, there is no alternative, as Stan also pointed out, is going to continue to keep people in equities. You know, the market's turned in many ways because the data's turned. Look at the jolts today, job openings and labor turnover. Look at this chart. It started in Dece of 2000. It has never been over 8 million. We have lots of jobs. We need to get busy, but we don't need to have more sugar out there. And finally, Stan said the reserve currency status, maybe 15 years. You know, on that one, he may be right. On my side of the ledger, I see that we've always graded on a global curve. And believe me, whether it's the EU or China or any other economy big enough to support the global currency status, I don't think it's going to be them. He thought maybe a crypto. I don't think so. I think the reserve status of the U.S. dollar is going to last a long, long time. Morgan, back to you.
Rick Santelli, thank you. Just getting a final check on the markets right now. The major averages are lower for a second straight day. The Dow's down 575 points. The S&P is down 1.4%. Every sector is lower. That's going to do it for Squawk on the Street. Tech Check starts right now.
Happy Tuesday. Welcome to Tech Check. I'm John Fort with Carl Quintanilla and Deirdre Bosa. Today, tech stocks of all sizes getting hit as the entire market turns over. How to position your portfolio to take cover or take advantage next. And then the face of the sell-off. Is it Cathie Wood or Chamath Palihapitiya? We'll consider. And finally, today's battleground stock is Facebook. The bull and bear case for Zuck and Company later this hour. Carl?
John, speaking of stocks, plenty of carnage in tech to mention today. NASDAQ now 5% off the most recent high. More than half of the NDX is down 10% from the recent high. Tesla's the worst performer on the NASDAQ 100 after AMAT. And then there's Apple down over 2% as the Dow, briefly, John, falls 667 points.
Yeah, Carl, that is where we will start this morning. As the tech sell-off gets even worse, guys, momentum, speculative names, they are getting crushed today. Cathie Wood's ARK Innovation Fund hit a new low, nearly 40% off its own recent high. Large cap stocks, they are not immune either this morning. We mentioned Apple, but all 5 of the largest names in tech, they're down in today's session. Software continues to get hit hard, as does cloud. Chips on pace for their second straight day of major losses. And guys, it's not just the divergence between broader tech and the market, but the plays within tech itself. Here is the year-to-date performance of ARK versus the S&P 500 and the NASDAQ 100, although the S&P just turned negative for the year. And guys, this graphic that you're seeing on the screen right now is a good illustration of those nuances within tech. ARK, of course, represents some of the highest flying momentum stocks over the last year. The NASDAQ 100, obviously broader, includes the mega caps. And this morning, John, Goldman Sachs had a note that said that they do deserve their multiples, but the analyst Costin calls antitrust investigation the greatest threat. And I'm not sure that I've seen it laid out that clearly or forcefully on Wall Street yet. So this is another thing that perhaps those mega caps will have to contend with this year.
Yeah, I think that's true. But guys, I think there's a big difference between tech overall and growth tech and mega cap tech. When you look at Apple, Microsoft, Amazon, they're right now, even, there's a lot of red on the screen. They're trading higher than they were at the beginning of the month. That's in contrast to what we're seeing with a lot of these growth stocks. And yes, there are issues of antitrust, but how long is it going to take that to play out? It's going to take a really long time, Carl. So in a way, if antitrust is the biggest worry, that might be bullish for some of these large names.
Yeah, I think Goldman would certainly argue the bigger threat is actually capital gains reform, tax reform, and corporate tax reform. But more on that later. We are going to get to all of this with our first guest this hour. Just downgraded tech to neutral recently. And this morning says the tech stocks could decline an additional 7%, would take you down to that 200-day moving average level. Tom Lee of Fundstrat joins us this morning. Tom, it's always a treat and great to see you again.
Yeah, great to see Carl and crew.
You've been pretty stubborn and resolute about sticking with what you call epicenter names or cyclical names that are exposed to the recovery. What makes you think there's more downside on the tech side?
Carl, I think that there have been 5 headwinds for tech that feel like they're coming to a head. In fact, I think Stan Druckenmiller in his interview today really spoke to it, that one of the overarching problems with tech starting this year is it's a crowded and stale long. People piled into these names last year because of the collapse of the economy and the pandemic. But now we have potential inflation building, interest rates going up. The White House could go after technology. The U.S. economy, not everyone believes it, but it looks like we're set for a full reopen by June. And then capital gains could go up. 5 of these is bad for the technology and growth trade, especially capital gains. More than 70 or 80% of all capital gains are just in a handful of sectors. And on the other hand, the epicenter trade wins on 5 of these. So if only 1 or 2 of these flips, in fact, happens, epicenter stocks are going to keep rallying and tech can weaken. So I think the move to the 200 days is probably the first reasonable stop to say, can we take a look to see if there's bargains? And that's, 7% downside.
Right. And then you go a step further, Tom, and you talk about, you're citing Nomura's quant team, that if you did get back to that level, you could be looking at what they called a crash up into cyclicals, where I guess the thinking is what? You get a new team of people who say, I want in on that?
Yes. I mean, I'm going to speak a little anecdotally, but in our conversations with institutional investors, they built their entire careers for the past 10 years, even 12 or 15 years, buying growth stocks and earnings beats. They've survived by ignoring cyclical stocks. In fact, that's the reason they kept their jobs. But the environment in 2021 is so different. It is the diametric opposite of the last 12 years. And investors are reluctant to actually have any exposure. I mean, this is what we find in conversation after conversation. They say something like, why should I buy energy? It's only 3% of the S&P. Apple's bigger. I got to get Apple right. I don't care about energy. But for the first time, maybe, since we've been recommending Epicenter, last week we got finally some investors to take a look at these cyclicals. So I think it's just the door has finally opened. We're probably in stage 0 out of stage 30.
So Tom, if there's, more downside for tech and you want to sort of get in on it as an opportunity, what areas are you looking at? We made the distinction between mega cap and cloud stocks and some of the more momentum names over the last few years. What would you be looking at?
I think, in tech, I guess you're asking about tech, Deirdre. And, what we said is, tech is really 40% of the S&P. We would want to only own half of that. So 20% should be someone's weighting in tech. So you still want to have some exposure. There's real shortages in semiconductors and the supply chain, and we know that's why there's real commodity inflation. So semi-cap equipment makes a ton of sense because you're going to be moving the supply chain to America. And I think any company that can actually ease inflationary pressures, and that's a lot of technology companies, are actually going to capture a lot of value. So I think anybody who works on the supply chain or helps contain inflationary costs are going to be the safe places in tech. And we identified 3 or 4 industries in our report Sunday that look decent in tech. But to me, the layup, those are, battleground. That's a battleground sector, as one of our clients in Connecticut says. I'd rather be buying energy here because, oil is already making a decisive movement. Energy has a huge catch up to that, especially things like oil field services, which, is OIH.
Tom, you're talking about what is safe in tech. Let's talk a little bit more about what might be smart in tech if you're looking to take on some risk. I mean, some of the volatility that we've seen, yeah, it's been crazy, but was it really that hard to see coming? I was talking to another Tom, Tom Siebel, billionaire, co-founder, CEO of C3 AI, just a couple weeks ago about this kind of volatility he's seen after his IPO. Here's what he said.
But it just shot up like a skyrocket. I can't explain why that happened. I think at one point it was trading, like at 100 times revenue. Well, you and I, John, know that companies don't trade at 100 times revenue in a sustained state. So we've seen, some of the air get let out of the stock since then, but it's still trading, I think, 70% higher than when than where we priced it.
And he said that some of the air coming out for the overall market, a good thing. What do you have to believe, though, about these growth stocks in tech with trends like AI to buy them around here?
Well, I think for anyone who's patient, tech's a bargain here, right? Because it's already off its highs. And these companies are going to grow double digits. I don't think tech's growth rate slows at all in the next few years. It's just the risk premia collapsed, and that's made them expensive. But, our long-term view is tech will easily become at least 50% of the S&P, if not more. I mean, the U.S. stock market is essentially becoming a tech index. I don't think that's changed. I think that's going to be true 5 years from now. And labor shortage means technology companies capture more value because how else can you replace labor? But I think the challenge is really finding something that's not crowded and not picked over, but can positively surprise. So I think that's the challenge right now with the cloud names and a lot of the work from home. I think semiconductor and semi-cap equipment can still positively surprise because at the end of the day, if you're moving the supply chain to America, I mean, that's a huge amount of investment. And, it's actually really an opportunity for the U.S. to create innovation. So I think you're going to see a lot of cool things come out of tech still, especially like autonomous driving as well.
Tom, you've done a lot of research ever since the beginning of COVID on the progression of the pandemic itself. I guess the question from me would be, to what degree are you building in a black swan, where could I be wrong scenario in which there's some variant that's resistant to the vaccines we have that would obviously send a lot of money flowing back into these names that is these stale longs, as Stan said, that where money is now seeping out?
Well, that's right on, Carl. I mean, COVID has proven anything to be super tenacious and unpredictable. I mean, in our daily commentary, we're terrified to actually make any forecasts. And where can this be taking place? I mean, at the end of the day, it's a virus that's mutating, and as it spreads, it keeps mutating, and we're seeing that super surge take place in India. So I would agree. I don't think it's a foregone conclusion that COVID is in retreat globally. And if India, if the surge lasts, that it causes the economy to shut down, as that's going to send a wave of panic across the global economies.
Yep, and we're hoping that's something we can avoid. That maybe we're past it, but certainly the ex-U.S. trends are still troubling. Tom, it's an interesting day to have you, and we continue to rely heavily on your work. Thanks so much. Good to see you. Tom
Thanks
Lee.
for having me.
Well, Carl, today's most interesting chart, that has got to be Palantir. It is now well in the green after a 10% drop pre-market, perhaps because it is the #1 mentioned stock on Reddit and Wall Street bets this morning. Earnings showed a beat, but saw net losses double. Or maybe it's the CFO, David Glazer, said Palantir is considering adding Bitcoin to its balance sheet. All that said, Palantir shares have fallen almost 40% over the last 3 months. Carl, now up, lost some of those gains, up about 6%, but still pretty remarkable reversal that perhaps tells you that not everything has to be based on the fundamentals here. Could be still some room for these momentum stocks.
Yeah, down 6% in the pre-market and up 6% during the day trade. Guys, when we come back, top picks, top value plays, and how you take advantage of a sell-off like today's. We're just getting started on Tech Check.
Dow down 600 points. And let's also get a gut check on Roblox going the other way. The company reporting their first results since going public, seeing a 161% increase in quarterly bookings boosted by pandemic trends, revenue growth over 140%. So if you're looking for something that is working today, that would be Roblox. Shares are up more than 10% right now, John.
Yeah, giving Palantir a run for its money on that interesting chart front. Now, cloud stocks overall losing some air over the past month, with high-flying tech names like Snowflake, Twilio, and others down double digits. ServiceNow, another name, down 15% since mid-April, under pressure again today. Of course, if you step back and look at a 2 or 5 year chart, steadier march higher for ServiceNow. So where do a lot of these software names go from here? That's where we'll start with our next guest, fresh off his Investor Day, Bill McDermott, ServiceNow CEO. Bill, good to see you. So you had laid out a plan for $10 billion in revenue in 3 years. Now you say $15 billion in 5. Ambitious, I guess you're being encouraging to investors. It involves
to me, it just
expanding
seems
your
like
total
common
addressable market.
sense and courtesy and
Well,
professionalism.
John, first of all, we're one of the few companies in the world that are operating on the rule of 60 plus. They say when you have 20% revenue growth and 20% free cash flow, you're doing great. We're operating at 60 plus. And yesterday we laid out a bold plan.
Well,
And
the reason I can't explain
issue
it looks like there's a
is how
second
big is this addressable market?
this,
Digital transformation in the next
come back
3 years will be an
Zoom is
$8
now
trillion market.
surging
Our space is 175 billion. And we're going to market in a way that really helps our customers transform their business. Our customers will need to get 20% of their revenues in the next 3 years from businesses they're not even in today. So business model innovation, the move to the multi-cloud, innovation at the edge of the enterprise, modernizing their applications, building low-code applications to satisfy new customer and employee demands. We are the control tower for digital transformation. And we laid out a plan to do this in industries and geographies, and we did this on an organic basis. And John, I want to make this clear. ServiceNow is the first company that ever became a $5 billion cloud company organically. ServiceNow will be the first company to be a $10 billion organic cloud company. And ServiceNow will be the first company in the world to ever be a $15 billion plus cloud company in the world. And that is our story.
So when you say organically that many times, does that suggest you're not doing M&A, or are you saying M&A that you do will be
related to
gravy
the fact
on top
that
of
there's limit orders put in, right?
Exactly. It will be gravy on top of that, John.
So
the reality is we don't need large-scale M&A. That's why we haven't done it yet. And why, you say, why is this? Why do all the other ones need it and not ServiceNow? We're a platform company, John. We go to market and we specialize in industries. So today we focused on manufacturing and healthcare. We're kicking off our Knowledge 21 event. I'm opening up with a keynote to 50,000 people globally in 130 countries when I get off this interview. And we integrate all these disparate systems and silos, and we glue together people so they can get work done in teams. We call this a system of action.
Bill, give us some more kind of granular management detail here. Of course, you've been at SAP. You've been in the tech business and leadership business for a long time. A lot of investors want to give a whole bunch of companies the multiple as if they're platform companies. And historically, a lot of companies don't tend to actually become platform companies. So how is it that you've been able to do at ServiceNow what you have with cash flow, with R&D investment discipline that you think is going to allow you to achieve those benchmarks that you mentioned and others?
5% yesterday.
That's the right question. John, today you're seeing a rotation in tech and niche tech, which was highly valued and probably benefited somewhat from COVID and other things, has really rotated down pretty heavily. When I compare ServiceNow to our peer group, I'm comparing it to Salesforce, Oracle, SAP, Workday, And if you look at us on a 10-year chart, we
Confirmed
grew
coming
faster than any of them
11%
with a
over
better
next week.
margin profile than any of the cloud companies and a better
So,
free cash
yeah,
flow
down into the
profile than any of the
40s
cloud
for
companies by
Bitcoin,
far.
46
Why is it? Because
down
we are
50
truly a
for a little while.
platform that
Swapping out to
spans the
54.
entire enterprise. When you think about modernizing IT or giving your employees a great experience or reinventing customer service in a direct-to-consumer world or building these new applications so business people and engineers can come together to change the game in days and weeks, not months and years, you're thinking ServiceNow. So this is a true enterprise software company, and there's not a lot of them around. If you look at most of the brands today, they're very departmental. And John, these islands of innovation are killing companies. They want a platform where they can glue all this complexity together and run a great business.
The tide is going out in the markets at least over the past couple of weeks, and we'll see what everybody's wearing. Joe McDermott, thank you.
Thank you very much, John.
Let me look at the 10-year Treasury.
We're keeping our eye on Kathy Wood's ARK fund in the meantime. A bit of a flip here, up 1%, but a tough morning. It did hit a new low for the year, down about 40% off its most recent high. We'll get a breakdown of the biggest underperformers in that fund when Tech Check comes back in 3 minutes.
Cryptos. Oh, cryptos. None of them doing super hot. I mean, today's just not a crypto day. The Dow is actually really hurting right now, down 507 points. And so is the Nasdaq's actually made a little bit of a comeback this morning. Still not positive, but comeback a little bit. The Dow is the one actually hurting the most right now, down 500 points, which is, what is that percentage-wise? 1.45%. Nasdaq down only 0.5%. S&P down 1.13%. So surprisingly turning into a positive tech day. Lumber. Hey guys, we've had lumber go down 2 days in a row now. I don't know the last time that happened. It's down 11% from its high just a few days ago. Yesterday morning hit an all-time high of 1733. So, geez. Looks like we're on a fire sale when it comes to 1544. Yeah, we'll keep hanging on, guys. We'll keep watching and seeing what goes on. It's been a very, very interesting day.
Get a gut check on Shopify. Loop takes it to a buy this morning, maintaining that $1,400 price target. Heady top-line growth and margin expansion, the chief catalyst behind that upgrade, says Shop should benefit from continued secular shifts to e-commerce. Shares just turned positive, but still negative year to date. Carl?
John, we continue to watch the ARK Innovation Fund hitting about a, 6-month low or so, but a bit of a reversal here. Let's get to Dom and Chu. Dom?
It's been a massive move off the lows of the session that we've seen so far for that ARK Tech Innovation ETF. But it's not just the Tech Innovation ETF that's also catching a bid. You just saw Shopify with John Ford over there. Other ETFs within the ARK universe, the ecosystem, are also catching a similar bid as well, moving into positive territory. We'll highlight 3 of them here. These are the 3 biggest active ETFs that ARK manages. The ARK Innovation ETF, ticker ARKK, the Genomic Revolution ETF, ARKG, and the ARKW, which is the next generation internet ETF. Now, from the highs that you see here earlier this year, each of these ETFs has lost roughly a third of its value in the course of the last several months here. So we've seen a similar move across all of these ETFs. But again, each of these ETFs is now positive on the day, indicating perhaps there is a bit of a buy the dip mentality for some of these stocks. Now, take a look overall at some of the other parts of the ecosystem that we are watching as well. The holdings within these particular ETFs, specifically Tech Innovation, because there are some names that we know from a momentum standpoint. Tesla, Teladoc, Roku, and Square. These ETFs here make up a large chunk, roughly 27% of the overall Tech Innovation portfolio. We put a 1-year chart just so you can see how much some of these have gone up. Roku's up 130%. Tesla's up still 280%, and Square's up 190%. But Teladoc is the standout here. After a massive move lower over the last couple of months here, Teladoc is actually now lower on the year so far. So keep an eye on those 4 stocks, critical to the, at least right now, fate of the Tech Innovation ETF. And then one other place from a momentum standpoint, the SPAC market, so hot over the last 6 or so months. Chamath Palihapitiya has a number of these names here in SPAC land. The Virgin Galactic, Open, Clover Health, IPO, which is in the process of the SoFi merger right now. You can see here, well off the session highs, or rather the year's highs as well here. So we'll keep an eye on some of these momentum parts of the market overall, Deirdre. It's been a huge move lower. ARK Tech Innovation, just maybe a proxy for the overall move, John. Something certainly to keep an eye on.
Dom, when I think about these names, I think about just belief in taking on high levels of risk, even in this market. And when we see the kind of volatility that we have, I wonder how shaky that platform is. I mean, especially given that Cathie Wood sold out of Apple in these funds, right? I mean, how much is the risky getting riskier?
So it's an interesting point that you bring up, especially when it comes to actively managed ETFs. What it comes down to is whether those ETFs in times of market stress or certain conditions of volatility actually track the overall value of the underlying assets. Many traders and investors look towards a concept called discount or premium to net asset value, or NAV. The simple way to look at that is when there's intraday trading of these portfolios, sometimes the price of the actual ETF can diverge completely, sometimes very markedly so, from the actual value of the underlying assets. It could happen in a situation where certain funds are liquidating certain assets, the liquidity profile kind of a huge variable there. What I will say is, as of yesterday's close, we were looking at the discount or premium to the overall portfolio that this ETF was trading at, the ARKK, the Tech Innovation ETF. John, I got to tell you, despite the fact that you are seeing some liquidations of certain assets, it was trading just at a very, very slight discount to its overall portfolio value. That will be key to watch in the coming days if there is more volatility, because those underlying assets can trade at a certain value, but the ETF could be significantly higher or lower. That's certainly a trend to watch, John. A very interesting question for sure.
Right, Dom, one that we'll certainly watch. And John, I know we were talking about this a little earlier, just the idea of Cathie Wood versus Chamath being the face of, the tech upswing and then the downswing. Looking at Virgin Galactic, those shares have recovered a little bit, but still down more than 5.5%. It does raise the question, where are the retail investors in all of this? Over the last year, we've seen them come onto the market in a big way and have, a big appetite for risk. Does that become a little bit tempered as we see this sell-off in tech, a lot of the names that they were really big into over the last year?
Yeah, Dee, people here, I work for CNBC, they ask for stock advice. I tell them I don't give stock advice, but here's the trick. You got to not only know what to buy, you got to know when to buy and when to sell. And a lot of people forget about that last part, Carl.
Well said, John. Let's get a news update this morning from Rahel Solomon. Hi, Rahel.
Hi, Carl. Good morning. Here's what's happening at this hour. On Squawk Box this morning, investor Stanley Druckenmiller said that the Federal Reserve's continued moves to keep interest rates low and big spending by Congress are not needed because the economy is now strong, and that growing government debt, he warns, poses a long-term threat.
There is no way we can afford to have 30% of all government outlays be toward interest expense. So what will happen is the Fed will have to monetize that. When they monetize it, I believe it'll have horrible implications for the dollar. And that's why I said in that speech, yes, that I think it's more likely than not, within 15 years, we lose reserve currency status.
And after bids for Victoria's Secret came in lower than hoped for, L Brands has decided to spin off the retailer rather than sell it. L Brands is keeping, however, Bath & Body Works. And for the first time in its history, the Washington Post has put a woman in charge of its newsroom. Sally Busby will leave the Associated Press, where she's been running news operations since 2017, to become the Post's executive editor. You're now up to date. Deirdre, I'll send it back to you.
Rahel, thank you for that. Well, this morning's battleground stock is Facebook. The bear and the bull case is up next, so stay with us. Check is back in less than 3 minutes.
Welcome back to Tech Check on CNBC. I'm Carl Quintanilla with John Ford, Deirdre Bosa, and Julia Borston's with us this morning. Stocks off the lows, as we sometimes say. The Dow still down 450 or so, but that's a lot better than minus 670 earlier today. S&P's negative for the month. Apple off more than 1%. Palantir's reversal is continuing, up 7% now. And look at the intraday of the NASDAQ, guys. Today's volatility clearly on display. We've been down as much as 2.2% and currently down less than 0.4, John.
Yeah. And now, Julia, Facebook's about flat this morning after a 4% drop yesterday. Part of the pressure, maybe 44 state attorneys general who want Facebook to scrap the plan for Instagram Kids. What's that about?
Well, John, there's a lot of pressure on social stocks over the past couple of days, and you mentioned those losses yesterday. Facebook is down fractionally this morning, but it's off about 5% for the week, under pressure on two analyst warnings. First, Citi downgrading Facebook along with Alphabet from Biden neutral, warning that expectations for ad growth are just too bullish. And Goldman Sachs warned that Facebook, along with other tech mega caps, face higher tax rates as well as regulation. Now, speaking of regulation, as you mentioned, John, Facebook is under attack for a feature it hasn't even launched yet, Instagram for Kids. 44 state attorneys general calling on the company to drop its plan to build that service, warning about mental health concerns and the idea that maybe this new app wouldn't be able to comply with federal children's privacy laws. Facebook countering that kids are already online. They're already using Instagram, saying, quote, we want to improve the situation by delivering experiences that will give parents visibility and control, saying that they're working with experts and will work with legislators and regulators. Analyst Michael Nathanson tells us he thinks Facebook should heed these attorneys general advice, that the state AGs are already suing Facebook for anti-competitive content. But John, it seems like Facebook is pretty determined to move forward with that.
I mean, Alphabet gets to do YouTube Kids. I don't see the attorneys general coming after them. I mean, do we really want government lawyers telling tech companies what they can and can't build?
Well, look, this is whenever you get into the question of kids, John, it always gets complicated. There are those federal privacy laws. And look, YouTube has been criticized for the YouTube Kids app not being sufficiently sequestered from traditional YouTube and the fact that kids are still using regular YouTube, not just YouTube Kids.
And so when we look at the pressure that Facebook has been under and how it has perhaps maintained its strategy throughout this, do we see them wavering at all, or are they pretty steady as it goes?
The strategy in terms of kids, look, I think Facebook wants to make sure that they have lots of different services. Overall, look, Facebook has Messenger for kids, and I think that once they start developing something, they like to see it out. They do a lot of experimentation, and not everything comes to fruition, but they do have this sense of wanting to keep on developing new things, making sure that they're not just stagnating with the same services.
All right, Julia, we'll see who's in charge there. Julia, thanks. Carl?
Thanks, John. In the meantime, Mike Santoli joins us on Facebook. Talk about some of the price action that we've witnessed lately in light of those recent downgrades, Mike, and what you call, I think, battleground territory now for FB.
Yeah, Carl, I mean, first of all, for all the reasons and all of those swing factors that Julia detailed, all the pressure points, there's room for both sides, investors and analysts, to debate those things. And also, though, on a valuation basis, this stock has now come into the zone of very value-sensitive buyers. This is a chart of the forward price-earnings ratios for Facebook, the S&P 500, and Alphabet for comparison since Facebook's IPO. By the way, 1 week from today is the 9th anniversary of that IPO. Obviously, traded at a massive premium in its hyper-growth phase back there in the early part of the 2010s. And what you see right here is the PE of Facebook and the S&P 500 are exactly the same right now. There is no premium anymore. If you take away the net cash holdings of Facebook, maybe it even looks cheaper. If you think the earnings are too low in the out years, it looks that much cheaper. And just you see also, Alphabet has actually waxed and waned relative to Facebook, does have this little bit of a premium right there. So I do think it adds a little bit of a wrinkle here. It's not about how much more should I pay up for the high quality business and the huge margins of Facebook. It's about how much risk is already priced in for all those other factors that might impinge on its business or maybe change, long-term sentiment about the quality of its competitive advantage, guys.
And Mike,
Great perspective, Mike.
It's just
Thank
not the
you
kind
for bringing that to us. And go ahead, Carl.
Mike, I was just going to say, it's not what you'd expect when revenue run rates are at 3-year highs, right? I mean, we're seeing an acceleration of that revenue expectation, not a deceleration. Although Citi's point is that that deceleration will come, just not until Q3 or Q2 of next year.
Exactly. Tremendous contrast between the numbers being put up by Facebook. Also, you could argue Amazon, which I think is trying to catch a little bit of a buying interest today, and where the stocks are trading and really the mood around them. It's kind of like as good as it gets moment. But yeah, I mean, there's nothing that really in the numbers tells you that Facebook should be revalued in a radical way. That's why there's this big debate going on.
Right, and that's great perspective, Mike. Thank you for that. Speaking of Facebook, Goldman Sachs says there are more threats ahead for the dominant 5 tech stocks. Find out what they are only on CNBC.com/pro. Subscribe today and stay with us. We're back in just 2 minutes. Watch Coinbase this morning. Oppenheimer initiating as an outperform price target of $434. It's sub 300 right now. Says coin is well positioned to benefit from the accelerated adoption of crypto. Calls its current level an attractive entry point for investors. Stock this morning is down about 1 1/3%, John.
Yeah, and Deirdre, now the group behind the pipeline ransomware hack says their aim is cash, not chaos, as President Biden prepares to meet with Russian President Putin over the cyber attack, among other things. Eamon Javers joins us. Eamon, if I were a hacker group secretly working in cooperation with a nation state, that's exactly what I would say. Oh, don't try to make me political. I'm just after the money.
Right. I'm just a mild-mannered bank robber. I'm not a nation-state spy sent to ruin your economy, right? I mean, that's sort of where we're at with this, right? The hackers are putting these statements out on the dark web, and you got to assume that they're lying. But what are they lying about and why are they lying? We don't really have any idea. I want to also flag for you, John, that we're getting now a revealing look behind the scenes at what happened as the U.S. government tried to respond to this and some of the communications that happened between the government entities and Colonial Pipeline at the same time. Up on Capitol Hill right now, there's a hearing going on, which is focused on this question of whether CISA, which is the nation's top cybersecurity agency, was brought in early enough and whether they have enough information now to respond to what happened to Colonial Pipeline. Senator Rob Portman asking the acting head of CISA some questions about exactly when they were brought in and exactly what information they have now. Take a listen.
Would it have been helpful to you if Colonial had contacted you immediately to provide information so you could respond more effectively?
So we received information fairly quickly in concert with the FBI. I think right now we are waiting for additional technical information on exactly what happened at Colonial so that we can use that information to potentially protect other potential victims down the road.
So Brandon Wales of CISA there is saying that the agency does not have, as of right now, the technical information that it needs to respond to the Colonial Pipeline hack and to prevent infrastructure attacks to other major American infrastructure players. So that seems significant. Wales sort of downplays it a little bit by saying, look, it's very early in this process. We've had a good relationship with Colonial Pipeline in the past, so not to worry. He has the expectation that they will get this information. But this attack happened last week, and we're sitting here on Tuesday, the head of CISA now telling Congress he doesn't yet have the technical information that he needs in order to respond to this. So that's an interesting look at sort of how the information flow is happening behind the scenes, John.
Eamon, is this sort of what makes the case for a cyber coast guard, the idea that the shores of America's digital assets perhaps ought to be more federally protected as opposed to by private interests?
Well, look, there's a lot of questions about that. What's the right role for the private sector? What's the right role for the government? What's the right role for the National Security Agency? Remember, America has some of the best hackers in the world over at the NSA. They're focused on cracking into computers overseas and doing whatever we do spy versus spy wise to foreign countries. Should they be involved domestically? There are laws that prevent that. But if they're the best in the world, maybe you want them on the beat, so to speak, as cops. A lot of debate about what the appropriate role is for all of these different agencies. But clearly what's happening now is just not working, right? This explosion of ransomware is unchecked right now by the federal government and by the cybersecurity firms in the private sector. So something needs to change. Not exactly clear what that solution is going to end up being, though, John.
Yeah. Meanwhile, Eamon, the focus is clearly on getting fuel supplies to the Carolinas and the Mid-Atlantic. Thanks, Eamon. Eamon Javers this morning on Colonial. Tesla was among the biggest laggards earlier today, currently down only about 2.5%, is now the attractive entry point for your portfolio. We'll talk about some of the good value plays in the volatile EV sector when Tech Check returns. Time for a gut check on Activision Blizzard. BMO goes to outperform this morning. Target of 116. They say the sell the COVID winners bears have shaken out at this point. Strong performance from Call of Duty and World of Warcraft. Also mentioned with its push into mobile, they say a catalyst for opportunity, D.
Yep, and Lucid Motors going public via the SPAC Churchill Capital 4. That stock is up 80% plus since going public, but since actually announcing the SPAC merger on February 22nd, the stock has fallen more than 60%. This year, the company projects to produce 6,000 to 7,000 vehicles and record over $1 billion in losses. And if you want another comp, look at unprofitable EV company QuantumScape. Reporting results last night was down 10% in the pre-market, but it has now climbed back into the green, up nearly 2%. Peter Rawlinson is the CEO of Lucid Motors and a former Tesla engineer. Peter, thanks for being back with us. Just talked about QuantumScape, but for several EVs, reality is hitting home lately. Production and profits proving to be elusive, and Lucid is still just selling a concept in spots like Saturday Night Live ad over the weekend. Give our audience an update on production and supply chain and whether you're still on track to hit the targets that you laid out previously, more than 20,000 vehicles in 2022 and $10 billion in revenue in 24?
Well, we're on track to put Lucid Air, the car behind me, into production in the second half of this year. And we're really making great progress here on three fronts. The factory's ready and up and running. The car is getting higher quality and getting closer to start of production on a daily basis. And we're rolling out our sales and service network. We've got 6 stores open across the country with 4 more to come in the very near future. So very much on track for start of production of what I hope will be an outstanding product in the second half of this year.
Peter, start of production, but are you on track for 20,000 vehicles in 2022?
We're very much on track for our plan. We're aiming for over 577 vehicles this year and a significant increase throughout next year as we grow the business.
Okay, but you won't repeat that 20,000 number. I'm noticing, Peter. Are there some hesitations around that? Is there any reason to think that you might not be able to hit that number that you laid out?
I'm very optimistic about our future potential for manufacturing. We're going to start production this year in second half. We're predicting 577 vehicles this year and significant growth next year.
Okay, Peter, I'm wondering if you can talk a little bit about your incentives. Elon Musk famously does not take a salary, but has an incentive-based structure that is tied to financial milestones. Can you give us any color on your equity in Lucid, your salary, especially after giving up majority ownership to the Saudi sovereign wealth fund a few years ago?
Well, I'm all in on stock options. That's what motivates and drives me. And that's really my view of the potential future of this company. So that's what I'm really working for, primarily stock options and my current stock options in the company.
And I just wonder, Peter, why go public now pre-production rather than raise more money in private markets? As I mentioned, you were quite successful in doing so from the Saudis. Do retail investors give electric vehicle companies better valuations and terms?
Well, I think we were in a very good position because unlike so many other startups, Lucid was in a strong financial position where we could choose our route to going public through either a traditional IPO or through the SPAC process. And we felt that the SPAC process was a very useful tool for us to secure a great amount of funding. We've secured $4.4 billion through the SPAC and the PIPE. And that collectively secures our future. It takes us well past the start of production of Lucid Air, the car behind me, and it takes us into 2023, close to when we'll be putting our second product into production, the Gravity.
Peter, thank you very much for joining us. We'll continue to track the company and look forward to seeing that vehicle in production. Peter Rawlinson, Lucid CEO. John.
Well, when it comes to currency, a lot of people think Bitcoin is the GOAT. Well, for Mark Zuckerberg, it's just one of the GOATs. And Ether hits another all-time high. We'll close out Tech Check after one more quick break. That's Mark Zuckerberg's Bitcoin GOAT.
All right, man. When they go to commercial break, we're going to talk about what's going on here with the market. Here we are at nearly 11 o'clock. Market's been over 2.5 hours. It's been a roller coaster wild ride. The good news is NASDAQ continued to just claw its way back up. It'll go up, then dip, and up, and dip, and up, and it's mountain climbing here. But it's very optimistic, right? Right now, down still 0.29%, so still down, not great. The Dow is actually taking a worse hit. It is down quite a bit lower than it was already down when it opened, so it's down 1.12%, which is over 400%. It's still higher than, 400 points, still higher than it was at its lowest, which is somewhat optimistic. Same with the S&P. Let's see what else we got going. Crude has jumped a little bit today. Again, I don't know if that's due to some sort of uncertainty with the Colonial Pipeline issue. Apparently that hasn't just gotten completely resolved and ready to put that behind us just yet. Of the cryptocurrencies, it seems like things are drifting back up, but nothing extraordinary. Litecoin, looks like Litecoin, Dogecoin, Ethereum, all drifting back up. Bitcoin drifting back up a little bit from its 55 something that it was this morning. Ethereum over 4,000 again. 2 days ago it hit 4,200, or just quite 4,200, 4,197, and I don't know if it'll get 30 today, but at least it's restabilizing after getting down to 3,800 or so again. 10-year Treasury yield up slightly today, but nothing crazy, up 1.37%. We're just seeing a lot of turnaround, especially from anything tech related. A lot of individual tech related stocks are turning around. Amazon started out the day absolutely terrible, and it was on a huge slide down from its post earnings report. It was at its worst, down 11% from its high back on April 30th down to early this morning. And now just since this morning, it's up 2.5%. So that's really awesome. Netflix also up quite a bit. It's up 1.46% for the day, probably up at least 2.5% from its low today. Zoom has done an incredible job today. Since its opening, which was absolutely astronomically low, it has gained 7.5%. It is now up 3% on the day. That is fantastic news. EXPI, another one of those big games. EXPI is up 14.5% from its low today. It opened insanely low at only $23 a share, which is just that stock is just getting brutalized out there. Let's see, Asana, which was down 6 something percent, is now up pretty significantly. Let's see what it says here. Yeah, it's up 8.5%. Roblox, which had some really good earnings yesterday, is just shooting up today. It's up 13% from its low yesterday afternoon pre-closing, and it's up 14.5% just today since its closing after, again, really positive earnings reports yesterday. Coinbase is actually positive. So we might have 2 days in a row of Coinbase being positive. It's not good this morning. Coinbase actually on May 6th, was about a week ago, hit an all-time low of 250. It is out 17% since then. Maybe we have something going for us. I don't know. It just had that 2 week after IPO lull, which happens so frequently. So it's good to see it positive. My portfolio's up positive. Now it's about 0.4% positive, which is crazy considering it opened about 3% negative. So probably about 3.5% negative first thing 6:30 this morning. Pre-market morning. It was an absolute bloodbath, as I have in the title of this video. It was absolutely terrible. I'm hoping for this to be one of those days where everyone snaps into it, realizing how good of a buying opportunity is, and buys it up, turns things around, and goes north. And that's exactly what happened. I didn't really expect that. I was hoping for it. That's what happened. what we're seeing. Ring Central, Roku, Stitch Fix, Snowflake, Square, Teladocs up 4%. Holy cow. Twilio up 3%. Zoom up 3%. These are all basically up double from what they were down when they first opened or pre-market. So, for example, Zoom was down like 4 or 5% pre-market. Now it is up positive 3%. That's about 8% swing from. That's just insane. Palantir's at 7%. On the negative side, we have a couple that aren't too good, like Norwegian Cruise Lines down another 2.5%. It's been up and down ever since CDC made questionable arrangements for cruise liners to start operating, and it's at its lowest in nearly a month. So yeah, I think we're going to see that with cruises until we get the complete fall from cruise liners, and we know they're going to start sailing at full force from the United States ports in hopefully not going to be towards the end of this year. Then we might see those things stabilize and it'll be good to like get back into it. I'm not saying if you're holding from back when Norwegian was $10 to $12 a share, then keep holding. I'm not saying sell now and buy later. I'm not going to buy back in Norwegian right now. Yeah, the EXPI DocuSign swing high. The momentum stocks are absolutely crushing it today. Crazy. A couple that are not crushing it necessarily. CCIV, which is, let's see, I'm sure it's turned upward today, but not great. So it's upward. It hit 16.17 first thing this morning. That's the lowest it has been since, I wouldn't say since it's SPAC. Yes, since the whole CCIV started, or Lucid thing started back in January. Pretty close. It's the lowest it's been since January 15th or 16th, about 5 days into trade. That's not good. We haven't heard a lot of news from Lucid. Like, it's completely silent. Lucid's been completely silent. The only thing that's really happened with Lucid at all, I would say, is they ran a commercial during Saturday Night Live right after Elon Musk's monologue, which is, I really wonder how much did they pay for that ad spot? B, I honestly don't know if it was as good of an ad spot as you think. In a way, you think, oh, that was crappy, and it did, but they didn't really make that ad. It was their long form theatrical 30+ second ad. It was a good commercial. I'm not criticizing it, but I am possibly criticizing how they placed it right after that. They didn't. That ad doesn't really scream, "This is not a Tesla," or "This is better than Tesla," or anything like that. So what I worry is you just had Elon Musk on this week, and they run an ad for Lucid, and if you weren't paying super close attention or you didn't know anything about Lucid, you didn't know this was different or rival to Tesla, you might end that commercial and think, "Oh man, that's a good Tesla." But it's not Tesla. That's not what you think. Let's see what else we got going on. Amazon up 1.13%. It was down like 2%. That's awesome. Affirm is actually lower than it was at one point this morning. Way higher than its low this morning. It was down 11%, 12%, something like that earlier this morning, right after the open. And it shot up to 55, or from 46 to 55, which is great. And now it's cooled off down to 53. We got a lot of ground to make up on the firm. I think it's still a good stock, but geez. I think myself, a lot of people bought it at the wrong time for the firm, which is too bad. It's a good thing I didn't buy too much. Wayfair having another okay day. They're not doing great today, I wouldn't say, but they are positive again today. Wayfair is crushing it. You can argue all you want about the stay home. They've been positive for the last 5 days in a row. Really gained a lot. So, I mean, we're seeing a good day. We're seeing today turning into a good day. It looks like an absolute murder scene first thing this morning in pre-market. We're seeing a little bit of traction on the cryptos. We're seeing the most from So Bitcoin Cash up 11%, Bitcoin SB up 15%. So things we're seeing traction. Nothing's really dipping. BTC is probably falling behind the most. I think it's about 1%. But I mean, it had a big week last week. A huge overpoint. Not sure why Bitcoin SB is doing as well as it is, but not going to complain. So anyway, we'll turn it back over to them.
HB down 3.7% this morning. That's pretty notable. It's a huge winner. It's up 33% year to date, even with today's sell-off. But you're starting to see some of the volatility move to other sectors. The VIX almost tagged 24 this morning. That's the highest level we've seen in a few weeks. So I think the action's healthy for people who aren't fully invested in the most aggressive trades, and now they have another shot at it. So I think you should be encouraged more than fearful.
Yeah, encouraged as well, Pete Nigerian. I think Josh puts it well. We've gone through it before yesterday, 35 straight trading days without a 1% drawdown in the S&P 500, one of the longest stretches, believe it or not, in years. The VIX got down to, I think, 15 or 16. It's popped a little bit today. We just showed it's at 21, but it's not at 35. It's not apocalypse now. It may not smell like victory, but what does this smell like to you? What is the market doing, and what is the market telling you right now, Pete?
Yeah, it's still part of that continuous, and Josh was indicating on talking about rotation. This is not a rotation that just started a week ago, 2 weeks ago, 3 weeks ago. This rotation started all the way back. You can go all the way back to October, November, and you suddenly saw the rotation that went into financials, industrials, materials, and they have been exploding to the upside. And Josh mentions the housing market as well. I'll tell you what, that when you look at many of those names in that market, they were just at 52-week highs for D.R. Horton just yesterday. So you're looking at names that have really performed really, really nicely. Yes, they're going to have a little bit of a pullback here and there. I think the thing that really stands out for me is, even though they've come back today, it's been sort of this theme of sort of hitting some of those names that are on that high list. And Stephanie talked about them being expensive. She's exactly right. They're not even expensive. They have no multiples on many of these names and very high multiples on many of the other names. And that's the whole thing is, you know, when you watch that rotation, just take a look at DocuSign, where it's been over the last period of time, and go through that whole list. And it's a long list of names where you look at them and they had this great run to the upside. They've had significant pullbacks, and today they've actually been all over the place in a nice big move, actually rallying and getting back into positive territory. But, you know, it's an interesting thing. I think the most interesting was the turn that we saw in the semiconductors today, because they've been coming after some of those names now. They started yesterday, a little bit early today, and it's something that I think we're going to have to watch not only into the close, but for the next week or two, because the semiconductors have really been on fire. And now all of a sudden we're seeing a little bit of weakness, a little bit of selling pressure on a consistent basis. And you just wonder, is this time to start dipping your toe in there or not? And it's a difficult thing, because that has been an area where we've seen a lot of pressure of late.
Yeah, Jim, I'm looking here at the screen. Zoom down 50% from its 52-week high. Peloton down 49%. DocuSign, Pete mentioned it, off 33% from its 52-week high. Let's be honest, a lot of people made a lot of money in these names since the pandemic and the lockdowns began. Is this in any way an unhealthy move? Rotating out of names, to Josh and Pete's point, where the valuations got stupid in some cases, if you could even put a valuation on it. Do you view this as an unhealthy pullback?
No, I don't think anything that's going on in the market, Sully, is bad right now. First off, those names that you're talking about, you know, most of them are up over 100% over the last year, well over 100%. So, you know, if you've been sitting on them during that time frame, you've got to expect that you're going to have big drawdowns like this. Now, here's where things get interesting, is at these prices that they've come down to, and with the way their business fundamentals, their earnings, in some cases their earnings, are growing, you're actually getting to a level where these hyper-growth stocks, they come down another 10, 15% on something like a Roku or a Twilio, and you can not only trade them at that level, but you can actually be an investor And the distinction being, as an investor, you can place valuation on multiples. You can place valuations on EBITDAs and growth rates and say, you know what? This is at a value that's below its intrinsic worth. That's a new stage for these companies that they haven't been in for years. I've talked about Roku and I've traded in and out of it over the last 3 years. But at no point have I said that it's an investment. It's always been a momentum trade. These things give them another 10% down, and I think they will go down another 10%, and you can start valuing these and make long-term investments.
I think what you're saying is they got to go down to kind of grow up, to mature in that market as well. Jim, I don't want to put words in your mouth. We'll get more on this. Right now, though, we have got a news alert. Steve Leisman joining us now. Federal Reserve and some news on the tape. Steve, what do you got?
Brian, thanks. Fed Governor Lael Brainerd making a speech about the economy and inflation, something high in the mind of the market right now, saying she sees reasons to expect the inflation increases that are coming will be largely transitory, sticking to the party line on that. She says it's more difficult to predict the size and duration of supply-side bottlenecks. She does mention the recent shutdown of the Colonial Pipeline. She's attentive to risks, she says, that inflation could prove more persistent, and that should it be so, the Fed has the tools to address it. Overall, she expects the deflationary forces that have held down inflation over the past several years to reassert themselves next year. The outlook is bright, she says, but risks remain as evidenced by the recent jobs report. Real quick, Brian, I want to share with you the high-frequency inflation data that we follow here from Price. State Street provides this from Price Out. It's web scraping data from prices from the web, hitting an all-time high for the series back to 2009. Year over year, 3.9%. That's CPI coming tomorrow. Maybe some upside risk there. This is something the market's going to have to deal with and digest before the transitory nature of this inflation, perhaps, Brian, reasserts itself.
You know, the great comedian Stephen Wright, Steve, just once said, everything is within walking distance if you have the time. Do we have any idea what the Fed's definition of, his joke, not mine, any definition of what transitory means? Seriously, do we have any idea?
Yes.
Is that a month, 5 years, 10 years?
Yes. And I also bought some batteries, Brian, but they weren't included. Yes, the Fed is talking about next year. This the inflation the inflationary forces. You have two things that are happening, or three things probably. The first thing is that you have the base effects. You have the old low numbers falling out of the year-over-year calculation. You have the supply disruptions going on right now, and you have some wage push pressure, and that's really pushing things up. Those things should work themselves out. Global supply chains reassert themselves. Everybody gets back in their own place, like a game of musical chairs gets back to work, and then we're back to where we were before. That's what the Fed thinks. What they're not doing, Brian, is throwing out roughly 3 decades of deflationary forces and saying that secular trend is going away as a result of the pandemic.
Fair enough, but you might want to rerun that data after this Colonial Pipeline stuff has gone through, because we've got gas stations. You know there will be gouging. Inflation and parts will go up. Steve Leisman, great stuff. Thank you very much. We're going to get to the FANG names in just 1 second. Stephanie Link, I want to go to you because you heard about it. The Fed, every day, there's no inflation, and if there is, it won't last. Is inflationary fear at all a part of what we are seeing in the stock market, or is it just something simply the bond market and nothing else?
No, I think inflation is definitely on top of mind. I got 5 questions from our advisors just today on it, right? So people are starting to think about it, and they're seeing it, and they're experiencing it firsthand. Their customers are doing the same. I've talked to a dozen companies, Brian. Everybody is seeing commodity cost inflation, everybody, right? And some companies are going to be able to price for it. That's good, that's fine, and some are not. So you have some winners and some losers. I think just about every consumer staple company said last week that they are going to be raising prices. So that's going to actually be something to watch for the consumer if demand kind of tails off. But there's so much liquidity in the system, right? So there is, in my opinion, not only just in the U.S., but also around the world, $100 trillion of stimulus in the system. How does that not lead to more than just transitory inflation on the commodity side? And then, of course, we just got a 7/10 increase on the average average hourly earnings number last week in the non-farm payroll numbers. That was a surprise to the upside. So I think you're going to start to have to see a lot higher wages. And that's the thing I worry about. Unit labor costs, they're zero now, but I think they go higher. And that's 70% of the inflation input. So that's something you have to watch.
Yeah. Well, and we have to watch it as well. 8.1 million jobs in that jolt you're going to have. By the way, maybe it's a good thing. People want to work. Now's the time to ask for that raise. All right, let's move on. The FANG names, the biggest of the big tech stocks, certainly have lost some of their bite lately, and they are being sold big time. Case in point, Amazon's down 8% this month. Facebook 7%, Apple down 6%. By the way, Apple is now lower on the year. It's one of only 8 Dow components down in 2021. And it's actually down the most of any Dow component this year. But Josh Brown, again, we got to separate these names, Apples and Amazons. These are long-term, give your kids these stocks types investments, right? These are not short-term fly-by-night because trends change in a year. These are long-term holds, I assume.
Well, they all doubled last year. And in the case of Apple, it's way higher than its average valuation has been in recent years. Now, you can make the argument for good reason. Apple has never been in a better position strategically, technologically, cash flow wise. Okay, fine. But it's tough to say that that hasn't already been priced into the stock. If you're a long-term investor, though, you're not abandoning it. You're sticking with it and maybe looking for opportunities to add to it. So that's always been my attitude. I've been in the stock when it's been expensive. I've been in it when it's been cheap. It's one of the biggest winners probably I'll ever experience in my lifetime. So how they do in any one quarter is not particularly important to me. But I think we can't move on from the inflation conversation because I think that really is the answer to why we're seeing large cap growth stocks, the FANG names included, trading off of their highs. But I think it's important to point out the best cure for high prices in the real economy are high prices in the real economy. So a lot of the stuff that you're seeing in commodities has to do with production shut-ins and just has to do with us catching up to the fact that a lot of the world was not able to operate last year. And there were all kinds of imbalances. And some of that stuff will be transitory. I do agree with Stephanie, though. You are going to see workers being paid more. You are going to see that start to show up, especially in corporate conference calls when they have the chance to complain about it. And you'll see it show up in the numbers, but I do think it'll be more than offset by the fact that the people that are now benefiting from inflation are the people who are in the bottom 50% of the wealth distribution in this country. They're benefiting from it. It's not hurting them as much as it's helping them. And that is in the form of increased demand for work. So I don't think it's definitely an overall negative. Look,
I agree, and that's why I said if you've got wage power, if you're working, ask for that raise now. By the way, Josh, I want to stick with you real quick. Follow up on that. You connected inflation to big tech. Is that because the effect inflation will have on bond yields, which could dampen growth, or is there a direct inflation correlation? Because Apple, by the way, probably one company not impacted by inflation because people are going to pay $1,300 or $1,200. Doesn't really matter. They need a new phone. They're going to buy one.
Well, this is the point that I want to make. This is actually the most important thing that I'm going to say today. And then I'll probably just, kind of zone out for the rest of the show. But if you hear anything that I say today, please hear this. Please hear this. All of the inflation that you're seeing right now is being driven by the wealth effect from the stock market. So if there's enough fear about inflation, or if the Fed is somehow forced to act quickly or forcefully, which I don't think they're going to do, but let's just say that's the thing you're worried about, right? And that's the thing that's producing volatility in the stock market. Well, that's great because it's a self-correcting system. The Fed will move or the market will move or both. That will take the juice out of the stock market. No more inflation problem. Everybody that you know that's remodeling their house, why do you think they're doing that? Because their 401k became a 601k. And they had to cancel a whole bunch of activities during the pandemic, which saved them money. All of the wealth effect is coming from the stock market. So if you think inflation is a threat, just understand something. If stocks cool off, that threat will be neutralized. People will come right back to this idea of, well, what else do I do with my money? And go right back into stocks. So I would not use that as the reason to get bearish here. But I accept the fact that it will produce some volatility in the near term.
Fair enough. And Pete Najarian, a lot of big new Mastercraft wakeboard boats, I'll bet you, on Lake Minnetonka, don't you know? But you sold your Apple, and Pete's like, I own one of those. You sold your Apple and Facebook calls. You sold the calls, not the equity. Tell us about the trade.
Right. Holding on to the equities, Apple's been my longest trade. It's been something that I call it a trade. It's been an investment because that goes all the way back into the 90s. And I don't mean price, I mean the year. So that's been something that's been there for a really long period of time. I continue to want to hold on to it. Josh was talking about long term. Absolutely. Long term. There has been nothing that I've heard from Apple in all these years that has made me want to say, you know what, I need to get out of this name because of this reason. But Facebook is another one that has turned into a long-term hold because they've been so Teflon, Brian, for so long. Now, I every once in a while, I want to double up and I'll buy calls. It didn't work as well in Apple because it just didn't perform as well. It did work pretty well for me in Facebook because Facebook made a pretty nice run. But you know what? Those are trades. The stocks themselves are investments, and I will be holding on to those two names. I like them. I think Facebook, no matter what they throw at it, it seems to be able to hang in there and then just continue to go higher. And just take a look at what it's done in the last 2 months, 3 months, 6 months. It's been an absolutely incredible run, despite the fact that we are seeing the CEO or some member of the C-suite in front of somebody in Washington, D.C. So it's just been amazing. And the cash that they're able to derive from what they do with their all the different companies they've got. I really think that there are still a lot of different angles that they can take and pull on all these different verticals that they've got to grow even more. So I'm really impressed with what they've been able to do.
Well, fair enough. Jim, you've been buying Apple. You think we could still make new highs this year?
I very much so do. People watching the show know that I was buying it in February and March. Loved those earnings reports a few weeks ago, and now it's come right back down. I am by no means thrown from this horse. There's talk out there about iPhone production orders being lower than expected in China. You want to talk about something that's transitory? That's transitory. That is not something that a long-term investor pays attention to. And let me put it to you this way. If the stock goes down, the company is buying more shares. They just announced a buyback. I believe it was $80 billion. They routinely shrink their share count quarter over quarter over quarter. They're going to keep buying more shares. This is very much a long-term hold. And whatever it does last week, this week is meaningless to me. I think it will set a new high this year.
Wow. There you go. A bullish call there on Apple. All right, Stephanie Link, you have been trimming Google, Alphabet, whatever, Google, but you're not dumping tech in total. So you're selling a little Google and buying a little Cisco Systems. Why?
Yeah, I mean, I'm underweight technology, and I have been pretty much all year. Look, I think Google Alphabet up 37% last week, and I just thought it was prudent to take some off. I'm still 200 basis points overweight the name. I also sold a little bit of Lam Research, up 27% year to date, up 120% in the past year. I think it's prudent just to take some gains when you have them. I think Cisco has really lagged, and for good reason. They've been very inconsistent, right? But it's only up 25% in the last year. It is a reopened name. Enterprise spend will come back as we go back to work. It trades at 16 times earnings, and it gives you a 2.7% yield. So I think the management is fabulous. Cash flow is terrific. And I just think it's underappreciated at this point versus these other names, which are, by the way, still very crowded. Back to my initial point.
All right, let's step outside of tech for just a bit. Bank of America out with a note saying that Goldilocks inflation, their term, could be positive for many of the banks, particularly the big ones, and naming Citigroup as a top pick. Jim, you got to love the call. You own Citi.
Yeah, well, I do like the call on Citi. I love the call on the space overall. We've talked about this for many months. This seems a very obvious setup. Interest rates, in my opinion, are going to go higher. The Fed's going to be late to move off the short end, so you're going to get a steeper yield curve, which benefits banks like Citigroup, like Goldman Sachs. You've got credit losses going in the reverse direction. That's a positive. They're green lighted on share backs, even more so than just back in November when they were first green lighted. Dividend yields are high. They're buying back shares in Citi's group below book value. So I feel very good about Citi and the big money center banks right now.
Feeling very good about it. Pete and Jaron, you know what else people are feeling good about? Is Vegas hotel reservations. Thought they'd be sold out by Labor Day. They're already sold out in some cases. Value stocks, the Bank of America note says that value runs tend to last about 5 years. You're a buyer of Las Vegas Sands. Is this a trade or is this a multi-year own?
It's not a multi-year own, it's a trade for me, but I'll tell you what, it is a trade upon exactly what you're talking about, essentially the reopen and how things are going, and we're already seeing good examples of this. Stock has not really performed, Brian, to this point. When you look back a year to date, where it started, where we are right now, it's been volatile, it's been a little bit higher, but it's interesting. It really has gone nowhere. So I do think that there's upside here. I continue to see option activity in here that tells me that they are betting on the idea, get it? Betting on the idea that this is going a little bit higher. So I certainly agree with them, and I'm jumping on board and being a part of that as well. With the calls, I'm not in the stock. I still think that the stock itself is interesting. I like it, but I'd rather be in the calls right now to use that leverage that I've got for the upside.
All right, fair enough there, guys. Good discussion. Good discussion on a lot of what's happening in the market right now. But up next, we're going to switch. Talk about another big story, and that is the very latest on the Colonial Pipeline shutdown and why some gas stations are now running out of gasoline. Plus, the red-hot commodities trade, the stocks that should be on your radar as well from that. And a reminder, you can always watch or listen to us live on the go if you're going out there, anywhere. Check us out on the CNBC.com app. Download it today. Halftime Report is back in 2. We'll see you then.
I don't know what's going on with AMC up there. We're watching it on the top page, the top chart. It broke 10. It was kind of doing this weird hovering right there at 9.9. Broke 10, looked pretty good, and then huge volume sell off right here. Broke it right back down to 10, and it kind of hovered, and then now it's going back down 9.94. So I'm not sure. It's just followed a very odd. An odd chart path today. I don't know how else to really describe it, especially if we go back to yesterday with this 10.9 spike after hours last night. I mean, look at the time of that after hours spike too. Was very odd, very odd, especially since a lot of late in the evening. So I'm not sure where that came from. I don't think it's news related. The only thing I can think is that there's some other sort of something else that was going on with retail traders, and they were using one of the other media outlets. So I don't see anything news related yesterday evening that would have caused that. 6% after hours update from the stock intensified shares broke above 10. And again, because the shares broke above 10, I mean, there's no real change, it doesn't look like. Still looking at otherwise some positivity going on with the tech stocks, stay-at-home stocks, recovery momentum, whatever you want to call these stocks. They seem like we're having a good day with them right now. I mean, we've got three traditional examples on the bottom have been some of the best beneficiaries of the stay-at-home world of the pandemic over the past 14 months, and but it's been hurting over the past 2 months, ever since their peaks in February. It's been hurting quite a bit as the perception is that things will reopen and these things will go away. I think all three of these companies are great examples of things, and it will stay with us for a long time. I think companies really like DoorDash might not go away, but might subside in their revenue growth. But I think these three companies, Zoom, Twilio, and Teladoc, all have like commercial and business to business implications. People are not going to just all of a sudden start going out and canceling their Zoom and Twilio accounts because they're going to be physically back in the office. Teladoc as well, I think, is going to continue in their what they do in that type of business as well. To me, I think we're going to see things like DoorDash might be one that might go down, slow down their trajectory. Peloton is also one of those that's thrown in. I think Peloton is going to do just fine because of a commercial pivot into gyms, hotels, and things like that. If they bought Precore, which is more of a commercial type of equipment manufacturer, and with that, and then just the now that people want that kind of that social media element to their exercise, I see Peloton and Precore building a long game of exercise infrastructure in gyms, in public areas. So you can go to the gym and still join the Peloton class. But I think that one's a little more. These three, especially, I think all three, probably Twilio is the best. Twilio, I think, is the most long-standing of these as far as if you transitioned from on-premise communications to Twilio or a Twilio or a provider that uses the Twilio platform, you're not going back to an on-premise telecommunications system. I mean, I suppose you could cancel your Zoom account, but you're not going to go back to an on-premise phone system when you went with Twilio. It just makes no sense. So I think that there's not necessarily a true logic behind the ups and downs. It's literally like an emotional gut reaction with some of those things. Anyway, so we're seeing some overall growth momentum. It's gone down a little bit in the past, 30 minutes, but I think it's a little cooling off. I think we're going to continue to see it kind of go. It's mountain climbing, right? It's up and up, and right now it's in a little bit of a down. I think it's going to continue to go back up. I don't think we're going to see a big sharp decline. The graphing of these momentums that I'm seeing today are going to continue to go up, which is really positive. I think we're going to. I am blown away by the turnaround of this space, and I'm really hoping that I'm right in saying that it's going to continue upward for the next few days. So what we do need to do is we do need to see lumber continue to go up. It's down twice as high, 2 days in a row. I mean, that's mind blowing. It's below 1600 right now, which is absolutely bananas. Down 10% from its high from just 2 days ago. So it's not like it was that long ago. So I'm really hoping that sticks. The other one that we want to go down is the 10-year Treasury yield. Right now it's up 1%, nothing astronomical, but it's up from its number yesterday. We're seeing the cryptos start to get a little bit of afternoon momentum here. So we might see a positive gain there. So it might end up being a day where I think we all thought we were going to all lose about 5% of our net worth between crypto in Texas. Now, man, we might actually see that just positive. Really, really good thing. So let's go back to these guys and see what else.
It has really
Yeah.
been an absolute extraordinary move of late.
Well, Jim, you've got institutional ownership. You've got university endowments. They won't own fossil fuels, right? Dump them. They're killing the environment. Just sell them. By the way, their loss may be some other people's gains. You like Marathon and a few others.
Yeah, Marathon, Kinder Morgan. And, you know, the problem with saying that you're not going to be in fossil fuels is that there is still a very long runway until renewables take over. Now, don't mistake me. I really want renewables to take over. That's better for the world. But the problem is we're just many, many years away in which we're still going to use fuels for transportation and electricity distribution. So pipelines like Kinder Morgan, it's not only benefiting from Colonial, it's benefiting from general higher activity through its pipelines. Marathon Petroleum, they're about to close on that sale of the Speedway unit, which will allow them to recapitalize their balance sheet. I like both of those companies. And with Pete, this extends to the basic materials, where cost cutting last year has become permanent and will permanently improve margins for basic material companies.
Josh, your take.
I don't have any direct holdings in oil companies. I don't want to personally fund them with my capital. I do, however, have exposure to them through many funds, index funds, actively managed mutual funds. So I'm not a purist in this arena. I just think there are better opportunities. However, these stocks had become entirely too oversold, absolutely thrown out, liquidated from the markets. They shrunk to less than 2% of the S&P 500. So the snapback seemed inevitable. I don't think most of these companies will exist 10 years from now. So if I were to be in the space, I'd be prioritizing cash flow, transmission operations like Kinder Morgan, or at least companies that have some sense of how they have to transform in the future. So BP over Exxon, for example.
And just make sure they have some cash flow, which many of these, to your point, Josh, did not have for about 10 years, or it was debt fueled. All right, a good discussion there, guys, on the Colonial News, waiting for updates from them. All right, straight ahead. Bullish calls on two consumer stocks that have both gone up 40% in a year, but we're going to debate if it's still too late to jump in and buy. Plus, May is Asian American and Pacific Islander Heritage Month. All month long, we are spotlighting our CNBC contributors, business leaders, and our own on-air anchors, reporters, and friends. And here's our friend CNBC's Ilan Moy.
I spent a lot of time as a kid trying to figure out American culture, and I am so glad that the conversation is now shifting so that people want to understand more about our culture. My advice to the next generation is never to hide who you are or where you came from, because those are the very things that will make you unique and indispensable in whatever work you choose to do. Never be afraid to speak up about who you are.
All right, welcome back to the halftime report. The Dow is down 511 points, 1.5% right now, being hit harder than the other indexes. The NASDAQ well off its lows, by the way. I don't want to call it a tech comeback, but certainly a bounce back, at least off the lows. The NASDAQ down 0.4%. Meantime, some bullish calls on the street today. Let us begin with Home Depot. Price target raised to 340 from 320 at Morgan Stanley. Jim, you own it. What do you think of the call?
Yeah, hey, listen, Sully, I got a little fire alarm going in the background here, but I'll still go through with this, which is the fire alarm is not to go sell Home Depot, okay? I own it. I bought it after the fourth quarter report when it went down. It's going to be fine. This is my lumber play, but I got to tell you, I'm not adding new money here. You got to respect it's up 24% and say, is this the time I want to buy when lumber prices quadrupled? So this is a solid hold, but don't add to it here.
Also, go check to make sure it's not, like a fire. Because with lumber prices where they are, you don't want to have to rebuild. Go check.
You're saying that would be a financial tragedy as opposed to a human tragedy?
Well, I don't know. Whatever you got in there, Farmer Jim. Goats, cats, just check it out. All right, next up, Nike. Good grief. Everyone's like, I got a fire going. What's that? Maybe it's a fire. All right, Nike upgraded to buy from hold at Jefferies. Steph, you previously owned Nike. Are you lured in by this call to rebuy it again?
No, not at 43 times earnings and for mid-teens earnings growth and upper single-digit total revenue growth. I just think that's just way too expensive. Look, I think they're doing all the right things on the DTC side, and that has very powerful implications for margins. But at the flip side, it is expensive. And you've got this issue of these boycotts in China, which I think could be pretty material. So not only that, but higher commodity costs, like we were talking earlier, they're going to be hit by that as well. So I just think I would love for this thing to pull back 15%. And then that's where I would be probably more interested. But yeah, it's just too expensive here.
Yeah. All right. And maybe getting more expensive. All right. Stay with us. Pete's latest trades in unusual activity is coming up next on the halftime report with the Dow down 500. Jim's going to make sure his house is on fire. We're back right after this. All right, welcome back. It is time now for unusual activity. Pete, what are you seeing?
All right, I'm going to start with the gap. And this one's interesting because it's been moving all year long, Brian. It's actually started out extremely low. It's just been absolutely accelerating to the upside. And somebody's out there seeing a little bit of a pullback today saying, look, let's take advantage of that by buying the May 34 calls. And they bought about 6,300 of these. They paid about $1.25 for these and actually hedged themselves by selling the upside calls up at 36.5. But basically what they're doing is they're looking for this stock to make a move back up and then may basically push upon the 52-week highs because this stock has been absolutely on fire. It's hit multiple times. They did a great job on their earnings report when they talked about their online sales and the growth that they've seen there. I've got a second one as well, International Gaming Technology, IGT. Now, this is another one. The stock was trading about 19.25 at the time, and a buyer of the June 20 calls. They bought about 8,000 of those calls, call it for about $1, and the stock started to move a little bit to the upside. Last I looked, it is over 20 right now, so it's already starting to make a little bit of a move. They also were buying the July 20s, and on top of all that, I believe we've got earnings coming up very, very shortly. So a lot of bets going on. Again, bets going on that this stock is going higher. I think it's going to be a really interesting one. I am in these calls. Lastly, I'm going to give you an update. Last week, I think it was on Friday, I had my final trade, Novavax. Unfortunately, the call buying that I had seen on there was not right, and the stock pulled back. But the good news about that is I could only lose what you paid for the options as opposed to the stock where you continue to lose as the stock goes further down. So I guess from that perspective, I feel okay about that. But unfortunately, we did have some of that upside call buying, and that did not work out.
Well, they did have a positive combined influenza COVID vaccine early trial data results. It didn't help the stock. And speaking of unusual activity, can we just show Jim, make sure he's alive, everything's okay? So that was very unusual activity, but everything is fine at Jim's place.
Sully,
put him up just to make Jim.
You know, Sully,
he's there.
I always aim to have grace under fire associated with me. Okay, but it was just a fire alarm, nothing to worry about. Barn is intact.
Grace Under Pressure, also probably Rush's third best album. Anyway, you've got questions about what to do in the sell-off. There we go. We have got some answers. Ask Halftime is next. We are back in 2 minutes. All right, time now for the investment committee to answer some of your questions. And keep the videos coming. First up, we've got a video question for Stephanie.
Hello, this is Sunil in Toronto, Canada. What are the 3 best sectors to invest in this environment, and the 3 best stocks as well? Thank you.
Steph?
Well, it all depends on your style and your time frame, but here are my 3 favorites. Industrials, because the economy is certainly recovering. One name I would own is Union Pacific, high quality company. Frustratingly, it's only up 7% this year, but I think there's margin upside. And obviously they're going to benefit from the transportation of goods. Discretionary with 27% savings rate out there. I think the consumer and the pent up demand is going to be huge. And I like Vail Resorts, top quality company, excellent management team, and they're basically in a duopoly with that great assets. And then in technology, I kind of lean on the more value side of tech, and that would be IBM with the new CEO. Well, not there, new that long. About a year now that he's been there. And he's focusing on cloud and AI, and they're shrinking to grow. They're selling their services business, trades at 11 times earnings with a 4.6 yield. So those are the 3 I like.
Yeah, big Squawk Box interview, by the way, the new IBM CEO. All right, Josh, we have got a video question from you, from a market newbie.
Hello, my name is Renika, and I just turned 10. I'm learning about investing, and I want to buy my first ever stock. What do you think as Airbnb as a long-term hold?
What do you think, Josh?
That's such a great question. Yeah, that's such a great question, and I love that so many new investors are thinking about this stuff and getting involved. I think if you're going to hold something for the long term, and at your age you definitely can, one of the most important considerations is management. And I believe that Brian Chesky, who is founder and CEO of Airbnb, will figure out a way to be successful over the long term. So I think it's okay. My favorite stock in this segment is Expedia. I like it a little bit better because in addition to having a business like Airbnb's, they also have all of the travel business, no matter where people stay when they go away on vacation. So I think both can work. And I wish you all the best of luck. Thank you so much for your question.
Yeah, great question, Renika. All right, next question is for Jim.
My question today is for Farmer Jim about GM. Jim, I'm a big-time GM bull, and I always appreciate your insight on the stock. My question for you today is, when are we going to get our dividend back? Thanks, and be well.
Jim?
Okay, good question. Listen, I'm going to blow your mind. I don't want them to put the dividend back in. When they put the dividend back in, there's a probability that they might be looked at as an old, stodgy combustion engine company. They might be looked at as a value stock, like a tobacco company. I don't want that. I want this to be looked at as the electric vehicle and autonomous vehicle company of the future. If they generate so much cash flow that they don't know what to do with it, buy back shares, not a dividend.
Okay, thanks for the questions. Final trades are coming up next on Halftime. All right, welcome back. Dow is down 608. All right, time for final trades. Guys, only 30 seconds. Apologies. We're going to go Steph, Josh, Jim, Pete. Go, Steph.
Stanley Black & Decker Tools and Storage is on fire, growing 45% last quarter. I think it continues.
Oh, we had to remember our place. I'm so sorry. I like General Motors. I would use this weakness today to buy the stock.
Cleveland Cliffs.
Sunrun.
Surprised Jim didn't pick Energizer for new batteries for the fire alarm. Thanks for watching Halftime Report. The exchange begins right now.
All right, thanks very much, Brian Sullivan. I am Dominic Chu in for Kelly Evans. Here's what's ahead on the show. The technology collapse. We'll get the technical take on the sell-off in the sector and give you two names who may be on the brink of breaking some key technical levels. Plus, they are not as sexy as Apple or electric vehicles or EV stocks overall. We break down one area of the market that doesn't get a lot of headlines, but is outperforming in a big way. Will it continue and how you play it? And how far the mighty have fallen. Chamath Palihapitiya's hot streak has been ice cold so far in 2021. We've got that story ahead as well. But we begin with the market sell-off as the stock slump continues. If you take a look at the picture overall, it's been a changing narrative. The Dow Industrial is still down about 600 points. Early in the day, though, it was the NASDAQ that was really underperforming. That's been the near-term trend. But take a look at this. As the market sell-off has maybe solidified a little bit more throughout the course of the day, it's the NASDAQ that has become the outperformer. At the lows of the day that we saw shortly after the opening bell, we were roughly down about 294 points. That translates to roughly about 2.25% downside overall at the lows of the day. But as you can see, we've been steadily trying to churn and climb out of that hole. We are now off about 0.2% after being off about 2.2% at the lows for the NASDAQ composite. Now, if you take a look at a sampling, if you will, of certain stocks that have been in the headlines as of late, these particular names have seen some interesting moves around. Snowflake, a recent IPO on the technology side of things, it's seen a huge fall off since its IPO, post-IPO highs, has now reversed course today and is up about 3%. Zoom Video is up about 3% as well after being lower on the day. So more momentum-driven trades, more newer technology. Meanwhile, Apple and Tesla are continuing to underperform. I would note, though, that Apple has touched today and gone down to its 200-day average price. It has found some support there as well. So Apple, Tesla, key stocks to watch. They have a lot more weighting than Zoom or Snowflake in the overall trade for the markets overall. So as we look at the big reversal today, what do the charts tell us may lie ahead? Is this intraday rebound a sign that the selling is done, or is it perhaps a head fake? With us now is Katie Stockton, Fairlead Strategies founder and managing partner as well. Katie, thank you so much for being with us here. Can you take us through the charts? Was there anything that you saw pattern-wise in those charts that indicated that we could be seeing a broader-based technology sell-off?
I mean, I think we're in the midst of it right now. The reason I think the NASDAQ 100 is outperforming today is because it is short-term oversold, whereas the S&P 500 and other benchmarks are not. So we are expecting a few days of stabilization on the back of that short-term oversold reading, but some damage has already been done. The NASDAQ 100 at the low today was down about 7% from its recent high, and that reflects weak short-term momentum and also weak intermediate-term momentum. This is within the context of the long-term uptrend, so we are looking at this as corrective, not the start of a big bearish reversal or anything like that, but we would note that the 50-day moving average, which sometimes is a little support gauge, has been taken out by the NASDAQ 100, and that puts the next support around the 200-day moving average, which I think right now is about 6% below. So that does create some potential risk. And what we're noticing with this growth underperformance is that some of the retests of support based on, in some cases, the March lows and or the 200-day moving averages are what we call unsuccessful, meaning we're seeing short-term breakdowns below those levels.
So if there are those short-term breakdowns there, can you take us through specific parts of that market that you are keying in on as possibly having even more downside ahead, or maybe trying to stabilize at this point, poised for perhaps at least a near to medium-term bounce?
Right. So the near term, I think the bounce lasts a few days, and that might be something folks want to use as a selling opportunity, particularly in those stocks that have broken short-term support. Some examples might be a Baidu or a Qualcomm, and Everbridge is testing support. There's a lot of examples of that. And then we can also focus on the larger names that are very close to support levels. Names like Tesla, of course, as it approaches its own 200-day moving average, and PayPal is doing the same. So as long as these levels hold, that would be an incremental positive for the NASDAQ 100. But you can see based on the small and mid-cap action that there seems to be risk of a breakdown, just given the relative strength loss behind the growth segment. You can see even in the NASDAQ 100 index that it's taken out a short-term support level versus the S&P 500 index. So it suggests that beyond the short-term oversold stabilization, that we can expect additional underperformance by the technology sector.
Katie, are there certain parts within this overall market narrative now that have acted perhaps more like tea leaves in your mind, maybe leading indicators? I know in the past some traders have talked about the semiconductor industry being one of those perhaps leading indicators. Other parts focus on mega cap technology, fintech as well. Some say momentum. In your mind, in your career, have you keyed in on certain parts of that market overall that you think are the ones who might tell us a little bit more about the overall narrative?
Well, we sometimes get leading indications from relative strength work, meaning that loss of relative strength behind the semiconductor sector was somewhat telling. But also in this environment, this is a little unusual, but 10-year Treasury yields have been trading off for some time. They lost intermediate-term momentum well ahead of what we're seeing now in the equity market. And up until, I'd say, early March or so, they had maintained a positive correlation. So perhaps they were giving us a cue that indeed the equity market was in store for some consolidation of its own. We're also entering into a seasonally challenged period. That's how I like to put it, from May to October. So it was also natural after a very, very strong April to see some selling start to kick in.
So is this, Katie, before we let you go, I mean, it's the cliche time, right? Sell in May and go away. Is that the strategy this time around?
I think things might get more difficult, but we've seen some real bifurcations on the sector level. That means you can still take advantage of the market on both sides. There's some sectors that are really starting to work here. We've seen breakouts in a lot of cyclical sectors. And now, of course, with this pullback, we're getting some more defensive rotation. You really saw that yesterday with outperformance from precious metals, from healthcare, especially pharma names, from utilities even. So there are ways to take advantage of a more difficult tape for the major indices.
All right, Katie Stockton with the charts and the insights there. Thank you very much. Have a nice day.
You too.
All right, well, stocks are cutting their losses after suffering their worst day in more than 2 months. At one point, the NASDAQ fell to its lowest level since March 30th. Hedge fund manager Stanley Druckenmiller discussed the recent market moves earlier today, this morning, on Squawk Box.
I think in terms of the recovery, it's had more to do with the rotation than it has with the stock market itself. As you know, Joe, that we started a very subtle rotation from August to October, which is accelerated now out of the COVID beneficiaries into what I would call reflation beneficiaries, reopening stocks, economically sensitive stocks.
All right, so rotations. Will this rotation then hold? Joining us now is Jim Paulson, Chief Investment Strategist at the Luthold Group. And I guess that's the perfect way to segue into this particular conversation, which is going to kick off with, does this market sell-off have any merits to buying?
I think what we're dealing with, I agree with the rotational concept idea. I think it's been going on throughout this bull market. It is accelerating more towards economically sensitive areas, Dom. But I think what we're entering into here is what I call reval time. In every bull market going back to the 1980s, the market, when it first takes off, is stock prices go straight north and earnings keep going straight south. A lot of times for the first year of the bull. That's exactly what happened here. And the problem with that is ultimately if prices go north while earnings go south, the valuation metrics become very extreme, and it sets up for the need to revalue the stock market. I think that's what we're entering into right now. And the reval is a good thing for the longevity of the bull. I think what we're going to do is cheapen this market through the end of this year. Most of that will come through better earnings rather than falling prices, and then set up a much better valuation going forward. Just to give you an idea, we had a reval in 83, 84, 93, 94, 2004, 05, and 2009, 10. And it starts when the earnings start to improve, which just happened in the first quarter, and when bond yields start to move higher. And we're right in that same mode right now. But in the previous ones, in the 1980s bull, the reval resulted in a 35% drop in the PE multiple while it went on, even though the market was flat for that year when it got 35% cheaper relative to earnings. In the early 90s bull, multiples went from 27 on trailing earnings to 17 over that same period of time. And in the early 2000s, it went from 22 to 17. And in 09, 010, it went from 26 to 16. I think, we were over 30 times earnings, Dom, earlier when this bull market, just not that long ago. I think as we go into next year, we might have a trailing multiple that's like 18.5 times earnings and looking much more attractively priced. So I think we're going to continue to have volatility. We could have a correction yet this year, but I think it's a buy yet going into next year.
All right, it's a buy. So how much do interest rates matter? If this is a revaluation, oftentimes that revaluation is driven because of valuation concerns, and those valuation concerns are driven by higher interest rates. So if the interest rate trajectory is holding where it is right now, does the revaluation need to happen?
I think it will, yeah. I think that we're having escalated fears about inflation. I think our growth rate this year is going to be like 8.5% real GDP, something in that ballpark. Globally, it might be the strongest growth year recorded. And I think it's going to continue to escalate inflation fears. And I still think bond yields, Dom, are going to end up above 2% yet before the year's out. So there'll be continued pressure on that, keeping stock prices, I think, in a trading range. But the good news is earnings, I think, are going to be spectacular. I personally believe we're going to have like $215 S&P 500 earnings by the end of this year. And, the first quarter, the annualized run rate on those first quarter earnings are close to $200 annualized share rate. So if we're already at $200 run rate, maybe 215 is not high enough. If we end the year at 4,000-ish on a $215 earnings, we're going to have a very attractively priced market going into next year. Even if rates are 2.5%, that's still some of the lowest rates in U.S. history with a below average PE multiple and another year of pretty good growth.
All right. So then, Jim, if that's the case, if there is constructiveness to be had in the market right now, there are certain places that are better values than others. What exactly are those particular sectors given that interest rate profile and the profile for earnings growth going forward?
I just look back to this, Dom, at the 4 previous reval periods that had interest rate and inflation pressures embedded in them. And what I found was you'd think you might want to move to defensive stocks, but where you want to move is to tie yourself to the cyclicality of the economy. The best performing groups historically have been cyclical stocks, cyclical sectors, and small cap stocks. And I think that's where you want to stay weighted in the rest of this year. Small caps have just been revalued very nicely, and I think Alfred and I buy point. Cyclicals have continued to just plow ahead, but I think they might continue to do that in the rest of this year as well. Now, there could be a trade as we get closer to year end, and we know the growth rate's going to slow down next year. It might be a time at that point to trade out of cyclicals and smalls. And quite frankly, I think it might be time at that point to go back into technology again for 2022.
All right. A resurgence of technology, possibly. Jim Paulson at the Luthold Group. Thank you so much. Great to get your thoughts,
Thanks,
sir.
Tom.
All right. Well, coming up on the show, it's the rotation play that's been under the radar, but still outperforming. We'll tell you what it is, where it is, and the names poised to make a run from here, possibly. Plus, Oppenheimer initiating coverage on Coinbase on inflation concerns. We just spoke about that a bit. The analyst behind that move joins us ahead to make his case.
This is The Exchange on CNBC.
to the exchange. Here's one bright spot in today's market sell-off. Shares of U.S. Steel are up about 3% today on the heels of Morgan Stanley's upgrade to buy on stronger demand. And it's not just steel prices nearing record highs. The cost of materials across the board are rising. The sector is up more than 20% so far this year. So could materials be that next hot sector to jump in and buy? Joining me now to discuss this is Carlos de Alba, analyst at Morgan Stanley. A lot of materials companies, raw materials companies in your coverage universe. Carlos, let's talk through why the materials sector is not getting as much attention for its outperformance. It's an even bigger sector than energy, but energy gets all the spotlight these days.
Yeah, hi, Dominic. Thank you for having me. Well, I think people have been away from the space for over a decade, and there is a lot of people in the market that are not familiar with the space. They're not familiar with the stories, and they are catching up as the stocks go up. And so it might take some time, but what I see from my conversation with investors is that they are doing the work. They are feeling the pain of not having exposure to the names, but they are really interested and looking into it.
Whenever I see commodity headlines like I've seen now, I think back, maybe about a decade or so ago, we talked about things like commodities super cycles. We talked about things like oil at $200 a barrel, that sort of thing. It doesn't feel as though it's getting as much attention these days. Is there a commodity super cycle in play possibly in the coming years?
Possibly. I mean, it's different definitely than what we saw in 2000, running into 2008 and then 2011 that was driven by China. This time around is probably going to be driven by the electrification of the world. The world needs to be greener, and that requires materials. It requires copper, it requires nickel, aluminum, silver, and steel. So that is what is going to be behind a super cycle this time around more than a specific country.
So is it going to be driven this time around? It's not your forte, I know, but the last time we talked about oil quite a bit. This time it's very, very much more geared towards things like steel prices, iron ore prices, copper prices, those types of materials. Is there a way that investors can still benefit? Is there still upside left to go? And if so, where is the most compelling outperformance forecast to be?
Sure. I do think that the investors can still benefit from what the stocks in the space have to offer, particularly when you looked at the last decade or so. The material space, the steel in particular, the S&P 500 steel sector relative to the broader S&P 500 has underperformed for more than a decade now. We're just barely at the same level that we were in 2000 before the prior super cycle. So I think as steel prices remain higher than people expect, and we now see hot rolled coil prices, which is sort of the benchmark commodity grade for steel, staying above $1,000 throughout the fourth quarter. As people catch up to this idea and bake that into their numbers, they will realize that there is much more upside to estimates and cash flow that the companies can generate, and therefore the shares will continue to run, in our opinion. We like US Steel as we upgraded today. We think that this is a transformational story in the space. They acquired an electric arc furnace in 2019, and then they completed the acquisition 100% late last year, and they are ramping up this new venture, and it's going to benefit their earnings power in a very good way, and it also is going to make them greener than they have ever been. So I think it's a transformational story that will benefit with higher steel prices. It's going to help deliver their balance sheet, make it stronger than we thought and what the market, I think, is expecting post this acquisition.
Carlos, there's been I guess a prevailing thought right now that the prospect of perhaps trillions of dollars worth of infrastructure spending here in the United States at some point down the line could be a tailwind for some of these raw materials types companies as well. As an analyst, how much do you kind of factor in the odds and probabilities around a massive undertaking around infrastructure here in the United States?
It's certainly a very bright spot for steel companies, those that are in the U.S., based in the U.S. Now, we need to see what the form and shape of those infrastructure projects that will be supported by the stimulus plan will be, because that will determine what type of specifically steel products, and therefore we are better able to define what companies will benefit the most. But broadly speaking, steel is steel, and higher capacity utilization for steel companies in the United States has typically been associated with higher prices and better profitability for the names.
All right, that's Carlos de Alba with the call there on U.S. Steel. Thank you very much. We appreciate it.
Thank you.
Well, coming up on the show, this stock is total garbage, and that's precisely why you may want to own it as the reopening gains steam. We'll explain the garbage chart. Plus, as we head to break, take a look at some of the online sports gambling stocks. Several bucking the downward trend so far today. International Game Technology, IDT, up more than 14% right now. You can see there Scientific Games of 7%. Churchill Downs, Kentucky Derby, up 2.5%. We're back in 2 minutes. Welcome back to the exchange. What a half day it's been so far. Now, at the lows of the session, the Dow was down 667 points. It's still down kind of there, 520 right now. But at the lows of the day, the NASDAQ was down almost 2.25%. Right now, it's down less than 0.25%. So a big move here in the midday. We'll see if that has momentum in the afternoon trade. Meanwhile, Wall Street's so-called fear index, the VIX, is crossing above the 21 level. That's its highest level since March. And then take a look at airline stocks, firmly in the red so far today. The biggest names all down around 3% or so. United, American, Delta, Southwest, Alaska Air, all hovering right around those marks. Now, a few stocks, though, are bucking the trend. Palantir rebounding despite falling double digits in the pre-market trade. The company reporting 49% revenue growth in its most recent quarter and said on its earnings call that adding Bitcoin to its balance sheet is, quote unquote, definitely on the table. The stock is trying to break its 10-day losing streak. It's still down 50% or so from its all-time high that we saw back in January. Those shares up 8% right now. Another outperformer today, Callaway Golf, on pace for its best day in a year after handily beating Wall Street estimates earlier on. The company saying demand for its products has been, quote unquote, unprecedented as the pandemic recedes. So those shares up about 12%. But Roblox, the big outperformer today, up double digits after reporting a 161% increase in bookings for its first quarterly results since going public back in March. Those Roblox shares on the gaming side up about 15.5% right now. Let's send things over to Rahel Solomon for a CNBC News update. Good afternoon, Rahel.
Hi, Dom. Here's what's happening at this hour. Federal approval today for a major project that would put dozens of wind turbines in the ocean, around 12 nautical miles off Martha's Vineyard in Massachusetts. The Biden administration calls it a critical part of its plans for renewable energy. The $3 billion project will create enough electricity to power 400,000 homes. Overseas, Queen Elizabeth opened the new session of the UK Parliament in her first public appearance since the death of her husband, Prince Philip. In her speech, scripted by Prime Minister Boris Johnson's government, the Queen laid out an agenda to boost the economies of England's north. And trainer Bob Baffert now says that he has found out that Kentucky Derby winner Medina Spirit was treated with an antifungal ointment that may have led to the test that found a banned substance in the horse's blood. Tonight on the news, a look at what all of this means for whether Medina Spirit will be disqualified as the Derby winner. You are now up to date. Dom, I'll send it back to you.
Lots of drama still at Churchill Downs. Thank you very much, Rahel Solomon. Cheap China stocks, social media snaps, and time to pick your way through the garbage names. Literally. That's all coming up. As we head out to break, a reminder that May is Asian American and Pacific Islander Heritage Month. Today we are highlighting our own Melissa Lee.
When I was 11, I wrote a letter to Kaidi Tong, who was at that time the evening news anchor on WABC, the local ABC station. I told her that I watched her every day and wanted to be a newscaster when I grew up, so she invited me to the studio for a broadcast. I will never forget how nice and encouraging she was, and it is a reminder to this day to pay it forward and help inspire the next generation.
Welcome back to the Exchange. Let's catch you up on a few stories that should be on your radar today. It's time for Rapid Fire. Here to break down the headlines are Tim Seymour, Chief Investment Officer of Seymour Asset Management, also a CNBC Fast Money trader, and Bob Pisani as well joining us, and Seema Modi as well. All right, first of all, the social media stocks presenting a mixed picture in trading today. Facebook, Twitter, Snap, Pinterest all pairing their earlier losses. The hardest hit of the group, Facebook, is facing a very real threat from TikTok. According to eMarketer, the social media sensation is set to take over Instagram in Gen Z users by the end of this year, and not even by a slim margin. It also says TikTok will surpass Snapchat in terms of total users by the year 2023. How real is this threat to the existing social media landscape? TikTok is not even a company, Tim Seymour, that we can invest in.
No, it's very real. Gen Z is an important demographic. It hasn't been the driver for social, but if you look at the story here, I think Snapchat really is the way to play it. Look, they're somewhere around 40% in terms of their Gen Z exposure. This is a company also as an investor and as a trader has had a pretty healthy pullback. But you heard Q1 numbers. They're going to continue to grow. First of all, Q1, I think 65, 66%. That's tough to duplicate, although the guidance on the second quarter was good, maybe not enough. But next 3 or 4 years, I think they still grow 50, mid-50s, and I think that's extraordinary. So I really like Snapchat despite TikTok's threat, as we call it.
So Bob Pisani, I mean, the social media stocks have become kind of like this, I don't know, a telltale of the overall market narrative. They've been momentum over the last couple of years. Is there anything that you're seeing with regard to the pricing action that leads you to believe that this particular industry, social media, is due for disruption from the likes of a TikTok across the Pacific?
Well, just look at what's happening. I mean, the answer is pricing is coming down. The multiples are coming down, so the market's already telling that. But look what's happening. This discussion is happening, shows you the speed of social media displacement. So Instagram used to be hot. Now it's not so hot amongst Gen Z. You get other things that are out there. Snapchat is still hot. At least I understand it still is, but it's sort of losing interest. And now TikTok is the hot thing amongst Gen Z. So the logical question is, how fast does this all happening? It's obviously accelerating. What's the new TikTok is really the question, Dom. And it's sort of like the opposite of what Andy Warhol said. In the future, nobody will be famous for 15 minutes.
So Seema, you are quite famous and you're a social media user. So what's your social media platform of choice and why?
For now, it probably would be Instagram. But listen, just looking through these numbers, Dom, pretty commendable that despite rising competition, TikTok is able to maintain its leadership position, especially when you think just a couple months ago, the type of pushback it was facing from Washington, concerns whether its parent ByteDance would have to sell off its U.S. operations because of the criticism it was receiving from the Trump administration. But despite all of that, it still has maintained its lead and really gaining market share amongst the Gen Z audience, which we know Wall Street really cares about. But to your initial point, it's still not an investable opportunity for mainstream retail investors because there's been a delay in ByteDance's IPO. All
right, well, let's kind of stay along the lines of tech and social media-ish, because let's talk about social capital. Chamath Palihapitiya, because his SPACs, his special purpose acquisition companies, pre and post deals, have been on a bit of a cold losing streak so far this year. Virgin Galactic tanking more than 70% off of its high from back in February. Clover Health and Open Door Technologies both plummeting about 50 plus percentage points from their respective highs, as you can see there. Social Capital 5, the vehicle that will take fintech software company SoFi public, will also, as well as Palihapitiya's other SPACs, are down around 30% or more over the past 3 months. Now, oh, by the way, guys, I just want to call your attention to something that's flashing on our screens here. The NASDAQ, believe it or not, is now in positive territory right now. It just happened in the last couple of seconds. It was down almost 2.25% at the lows that we hit literally within minutes after the opening bell today. A big move here. Again, we were down massively in the NASDAQ, and now for whatever reason,
NASDAQ goes positive for like a split second and then back to negative. But the fact that it's even flipped positivity today after opening today, futures down like 2.5%. It's like terrible that getting 2.2% in such a pre-market.
I mean, this is maybe a sentiment gauge, right? Bob Bassani, we'll start with you here on this.
Crazy.
These were the hottest things since sliced bread just 6
It's
months
got
ago.
my portfolio up
These are speculative
about
tech stocks,
1%. We went
cybersecurity,
down
3D printing, a lot of
probably
clean energy,
close to
that kind of stuff.
3.5%
It does not
pre-market.
trade
I
on
mean,
fundamentals, as you point out.
if
It
I
trades
took the
on
snapshot
very
of the
hopes
worst
in the
number
future.
at probably
Someday somebody's going to make a bunch of money on
7:30
this.
this morning,
The problem is, you
we
notice
got
we're all down about 30% as a group. All of the stuff, about 30%
so
is the baseline.
I'm
And that's what's
really
happening
hoping that
today,
this
trying to
turns
figure
into
out
a
a bottom.
full
That's why we're starting to rally,
swing.
because some people are saying, okay,
Maybe
50%
me
down,
my
that's
pilot
enough.
we're taking for
But
ERIB
the
just
problem
hit
happened in February when
10
rates
this
went up,
morning.
concerns about inflation went up, and
That
these
would just be
stocks become
amazing.
much
It
less
really gets an
attractive when rates go up
outlook
and
of that.
inflation goes up. Nobody
I mean,
wants
it's
to
not
trade on
crushing.
vague
It's
hopes
from
of future
29 or
profits.
26
There's other
to
concerns when inflation
26.40.
hits the
So
fan,
it's like
and that's
crazy.
basically been the
That
problem
was
ever since with these stocks.
a
Has the
limited
SPAC
order
craze in your
this
mind,
morning.
is it going to cool off for
Super
quite
excited
some
about that.
time right now?
Zoom's
Or
back
is it just
over
due for a
20.
bounce back again once people start to figure out that
Man,
they want to be
Zoom's gone from 270
risk
to
in the risk again, so far, so to speak?
in
That's the key question, Dom. I think increased
that
regulatory
is
pressure, does that make
rather
SPACs less attractive going forward? And when you look at Chamath, who's been an early believer and
just
proponent
simply
of this
amazing.
SPAC
You're
trade,
technically open at
Galactic down
275,
71%
pre-market
from its
270.
February
So we're
high,
looking at
Open
over
Door, Social
270.
Capital, other names he's backed. You wonder
Just some
whether this is just a
incredible
moment
credit.
in time where investors are reckoning whether this is a great investment for the long
So
term
I mean,
or a
your
one-time blip.
high
By
growth
the way, it's not
momentum
just Chamath. Even
stocks
Brad
are just
Gerstner, who has Altimeter
through the
Growth,
roof.
who took Grab public through
Go
their
to
$40 billion
into
deal
the
on
after.
April 12th. That SPAC is also
I'm
down
just
double digits this
I
week.
really
Tim
hope
Seymour,
this
does the
is
SPAC
a
cooling off provide you at
catalyst,
least a
an
little bit of
inflection
comfort
point
that maybe
catalyst
we
that
could ratchet things up again later on this
turns
year?
the
Well, it's
things
possible
back
pressures.
around,
Things are very
back
frothy, and
we should be.
SPAC space has been discussed around Chamath. Is the cult of personality space. So investors are sometimes blindly buying without looking under the hood. They're buying a group of sponsors, and that's good and bad. But you know, note the performance of the sponsors, and I do think you're going to continue to see SPACs as a vehicle, especially in a world where money's free. But this isn't just about pump in the market. I actually think, a private equity type investment in a public wrapper is very important. I think what the SEC is doing is also very important, not something investors should be concerned about, but actually clarifying the rules. And this pause and this slowdown is also very good for the SPACs themselves. Like the asset prices that they were all chasing have cooled off a lot. And I think that's good for all investors. I like SPACs as investments. I don't think you have to chase them at all, ever, and know what you own.
Yeah, I mean, electric vehicle ones, we didn't even talk about those, but those have cooled off considerably here as well. We're now going to turn to China, where analysts at Goldman Sachs have identified cheap Chinese equities that investors should buy. Now, the list includes semiconductor stocks as well as the names in the health and insurance space as well. But the big ones are the Chinese tech companies. You know the names. It's like Tencent, Alibaba, Baidu. They get a buy rating from Goldman analysts, which the firm sees as having an attractive valuation as well as solid growth potential. Only one of those, by the way, higher on the day. That's Baidu. The Crane Shares China Internet Index is getting hammered over the past 3 months. As you can see there, it's been a downtrend for sure. Let's start here, Tim, with you. You've been a global investor for a number of years now. Is there anything attractive about the pullback in Chinese internet stocks that says, hey, we should go in there and buy?
Well, it's attractive because, again, as an EM investor, I used to invest in the MSCI, and the top end of the balance sheet in that index were banks and commodity companies. It's truly now repositioned to have some of the biggest tech companies in the world at the top of the balance sheet. The story around Baba, I think, is really one where, investors should be excited that they got through this market regulator fine. If you look at the sum of the parts there, their e-commerce business, their internet business, their cloud business, their investments business, this is a very, very cheap global mega cap company at a time investors are speculating about what they should pay for NASDAQ stocks. Tencent, it's the world's biggest gaming company. It's the world's biggest incubator. I think both under a lot of pressure from Big Brother. In other words, the macro dynamic with the regulators in China. I think that's overdone. So I totally agree with this call. I think investors just need to be in for the longer haul because I think volatility is inherent in these markets.
Seema, that's a great point that Tim brings up, because it's big tech in China getting the same kind of regulatory scrutiny as big tech here from the U.S. government. How much is that regulatory landscape going to play into valuations? Should they still be a buy?
Interesting you mentioned that. I love this quote from NYU's Aswad Damaradin, Dean of Valuation, who says the success of China's internet giants is closely tied to their relationship with Beijing. You know, a couple years ago, the thesis behind owning these Chinese tech stocks was, look at the Chinese growth story, the growing middle class, adoption of technology. That's the reason you want to own these companies. But now with this increased regulatory pressure, the pushback they're receiving from President Xi and his administration, that of course has created a number of headwinds for these stocks.
Bob, there's also been a lot more attention on ETFs and mutual funds that go into these so that you don't have to pick your own stocks. How much is that ETF trend going to play out in Chinese EM type investing?
Well, it matters a lot. MSCI is poised to announce that they may take Alibaba, which trades right here, the U.S. listing, out of their indexes and use the Hong Kong-based index. That's been going on recently. There's been some moves out of the U.S. markets here into the Hong Kong market. But I agree with Tim. I think this was a good call by Goldman. They're cheap on a. I mean, look what's happened to these stocks. The big cap, mega cap China stocks have had the stuffing kicked out of them, much more than U.S. mega cap. Apple's down 10%. Alibaba's down 35%. Baidu's down 45%, something like that. They trade in a low 20s as a multiple. That's very cheap on a historical basis. So I think just on a relative valuation on a call, I got to give it to Goldman. I'd agree with them.
All right, big tech America versus big tech China. They're a big trade to play out in the next year. Finally, we all know that saying, one man's trash is another man's treasure. But is that actually the case with regard to garbage stocks? Literally, waste management, garbage. Waste management, waste connections, both lower today, but maybe this is a possible buying opportunity. Both stocks are up nearly 20% over the past year. Seema, you've actually been tracking this garbage trade for us. It's not really a garbage trade. What exactly is the upside here left for companies like Waste Management and Waste Connections?
Yeah, let's do a little trash talking. And no, I'm not talking about J-Lo and Ben Affleck, but waste management services. This has been a winning trade. It's not the sexiest part of the reopening trade, Dom, but a trifecta of things helping these companies. One is you have more employees returning to work, residents coming back to the city. That's increasing the number of waste. That's increasing the volume of waste and the frequency of pickups. And then you have this recycling tailwind tied to ESG that's also increasing demand for these companies' services. So Jefferies actually calls it one of its best reopening trades that is underappreciated by the market so far.
All right, so yes, Bob Pisani. These are names we don't often talk about, but is there an opportunity there just based upon, are we just hunting around for the next quote-unquote reopening trade?
Yeah, we are. And I have I'll tell you one point, and Seema is right on all those points. Commercial garbage pickup has much higher margins than residential pickup. That really bodes well for them because that's what's going to start picking up. That hasn't been doing anything, and that's got a nice tailwind behind it. The problem I have is everyone kind of knows that, who knows something about waste management. So this is a very expensive stock. We're at new highs. Look at that stock in the last month. We're probably close to 30 times forward earnings. Maybe 28 or 29. That, historically is a very high multiple for waste management. So it's not like people haven't sort of figured out the reopening story. And this is a reopening story at its heart.
All right. One man's trash, another man's treasure for sure. Thanks very much, Tim Seymour, Bob Pisani, and Seema Modi as well. That was your edition of Rapid Fire for the day. Still ahead, shares of Coinbase are reversing course today, now higher, and Oppenheimer is bullish on the stock, initiating coverage with an outperform rating and thinks there's a 48% rally ahead. The analyst making that call will join us next. And let's take a look at the NASDAQ. Again, now positive after starting the day, down over just around 2.25%. Some of the leaders right now, Splunk, Zoom, Match, DocuSign, PayPal. You can see they're all up roughly 2 to 5%. The exchange is back after this. Welcome back to the exchange. A mixed picture for cryptocurrencies today, as you can see behind me here. Dogecoin seeing the biggest gains, up 9%, but still nowhere near its highs that we saw pre-Elon Musk and Saturday Night Live. Now, despite the volatility in the space, Oppenheimer is bullish on Coinbase, calling it an enabler of crypto innovation. It's initiating coverage with an outperform rating and a $434 price target. Joining me now with more is Owen Lau. He's the senior analyst at Oppenheimer, responsible for coverage of Coinbase. So maybe, Owen, the best opening salvo to you here is that's a lot of upside. Why?
So first of all, thank you for having me, Dom. Yes, there's lots of upside because we see there's a misconception in the market that the higher the volatility of Bitcoin, that should benefit the trading volume of Coinbase. What that means is the revenue should go up, earnings should go up, and we see substantial earnings upside from here. And the stock also pulled back by quite a bit from around $380 at the direct listing price to right now, I think trading at around $300.
All right, so that I get the market volatility. It's the same reason why we look towards maybe online brokers. We look towards some of the investment banks when markets go volatile because you can make spread, you can make any kind of profits there. The Coinbase story is interesting because they continually say that the institutional investment is going to benefit them, which I understand. It's a much bigger market. But the commissions or spreads that you make from institutional trading are a lot smaller than if I were to go on there on Coinbase and trade Bitcoin or Ethereum or anything else. So what about that margin compression story? The more institutions that get in, the thinner the margins.
Yeah, I hear from you. I hear you about the fee compression, but I also believe this conversation is a little bit overblown. So we don't know the future, but we look at the asset classes in traditional exchanges like CME and ICE. We saw that there was a fee compression or revenue capture compression in these traditional asset classes like energy contract, equities contract. But we also saw with the mass adoption, the trading volume, it's more than offset the fee compression or revenue capture compression. So what that means is net revenue would continue to go up. So that's why I think it's too early to conclude that the fee compression would impact Coinbase model. And if we look at the traditional exchange, I would also argue that the trading volume would even more than offset the fee compression.
All right. Owen Lau from Oppenheimer with the call. $434 there. Oh, by the way, hey, I just have one more before you leave. Can you tell me what you think is going to be the big driver for cryptocurrency trading? Is it still Bitcoin, or is it going to be more and more Ethereum going forward?
Yeah, so that will be another wave. So the next wave would be Ethereum in my view, and also the next catalyst could be the ETF, the Bitcoin ETF. If Gensler is going to approve that, that will be the next big thing.
All right, Ethereum, the next best thing or next big thing possibly. Owen Lau, a $434 price target with an outperform rating on Coinbase. Thank you very much. Have a good day, sir.
Thank you.
All right, well, energy stocks are getting hit today as gas shortages begin to crop up thanks to the cyber attack on the Colonial Pipeline. We'll get the latest and how much pain could be at the pump coming up next. The exchange will be right back. Welcome back. The fallout from the Colonial Pipeline shutdown continues, but drivers may find all of us paying for it at the pump. Pippa Stevens is here with the impact it's having on gasoline prices. Pippa, I will admit I have not filled up yet this week. It's only Tuesday, but my plan is to fill up tomorrow right here in New Jersey. Will I be paying higher prices?
Hey, Dom. Well, you're one of the few people not filling up right now. It's the fourth straight day of the majority of that pipeline remaining shut down, and consumers now starting to feel it at the pump, both in terms of price and availability. Pipeline, of course, a key part of the country's energy infrastructure, supplying about 45% of the East Coast fuel through a network that spans more than 5,000 miles. Now, gas prices were already on the rise ahead of this, and AAA sees them rising even more in the wake of the pipeline shutdown. As of Tuesday, the national average for a gallon stood at $2.98, just a few pennies away from that $3 mark and around the highest level since November of 2014. Now, traders say that tanks were well supplied heading into the shutdown, but now consumers are unsurprisingly worried, so they're heading to the pump, and that's creating shortages, with some stations completely out of fuel. According to the latest data from GasBuddy, more than 7% of stations in Virginia are totally wiped out, Dom. So consumers hitting the pumps, and that is creating this shortage here.
It feels like the early days of the pandemic when you couldn't find paper towels or toilet paper on any store shelves. It seems as though that GasBuddy data that we just showed shows most of the outages happening in the South to Middle Atlantic part of that pipeline path. Here in the Northeast, it's a little bit different right now. Can we expect to see this resolved sometime soon? What's the time frame? What's it going to be? And what exactly needs to be done in order to get us where we need to be to get this pipeline reopened again?
Well, time frame is completely key here, and we don't really have that much information around the time frame. The last time we heard from Colonial Pipeline was last night, when they said that they expect their systems to be back up and running by the end of the week. But so far, only part of one main line is back up and operational, and that's only on a limited basis, and it's being manually operated. So we can continue to see shortages if consumers continue to hit the pumps in anticipation of there being a greater supply shortage. But it's really important to note that this is heavily localized.
Sure.
It will be concentrated in areas along the eastern seaboard. Additionally, there are ways around this.
Right.
They can waive the Jones Act. Georgia has repealed the state tax right now on gas. So there's
Sure.
certainly actions that the government can take.
All right. Pippa Stevens, CNBC.com energy reporter. Thank you very much. We appreciate it. That does it for us here on the exchange. Coming up on Power Lunch, much more on today's market action, including the recent collapses in EV stocks. Power Lunch is back after this break.
And welcome to Power Lunch, everybody. I'm Melissa Lee along with Courtney Reagan today. Stocks are lower, but a midday comeback has made these numbers seem a lot less bad, especially for tech stocks. The NASDAQ actually briefly turning positive. Kathy Wood, meantime, selling 30% of her Apple stock. Warren Buffett once sold his Apple, but now calls that move a mistake. Will Wood also come to regret her decision? And our EV stocks running out of juice. They're higher today, but the declines this year are ugly. Will they rev up again? Power Lunch starts right now.
Thanks, Melissa. I am Courtney Reagan. And as Melissa mentioned, stocks are selling off for the second straight day. This time, the Dow is lower. Remember Dow 35,000? Well, we're a lot closer to 34,800 points from that 35,000 marks or thereabouts. Let's get over to Bob Pisani, who has more at the New York Stock Exchange on what's dragging us lower. Hi there, Bob.
Hello there, Courtney. We are down but stable, and there's some very interesting turnarounds that have happened in the middle of the day. First, the issues everybody is most concerned about, which is mega cap tech. Many of these stocks 10, 12% off of the highs, but you see here, much more stable. Mega cap tech has held up better because it's got more long-term fundamental investors who will stay with it despite a little bit of a recent drop. What's more concerning is what we've seen with the more speculative tech areas, 3D printing and cloud computing stocks. A lot of these names you're looking at here, Fastly, JFrog, Snowflake, they're 40%, 50% off of their 52-week highs. Now is the day where you're seeing investors start to say, well, how far down do we have to go here? They're not going to go to zero. 50% off, that's a pretty steep discount. I think we're starting to see people pick around at the bottom in some of these speculative tech names. Meantime, keep your eye on the reopening stocks because a lot of these names have run up tremendously. Look at these home building stocks. D.R. Horton, for example, was $65 in the beginning of the year. Look at it, it's $99. Pulte was $45. Now it's almost $60. These stocks have had big run-ups, so there may be a little bit of concerns about valuation at this point. Same with the autos, by the way. General Motors has doubled since November of last year. It was $30. Look, General Motors is $60 now, essentially. That's a doubling in 5 or 6 months. Borg Warner's up dramatically as well. So, guys, keep an eye, Sarah, keep an eye on the overall valuation questions for some of the reopening names as well. Guys, back to you.
You know, Bob, what I think is interesting about today's session is that we saw the yields on the 10-year note, rise ever so slightly, and yet we have this huge bounce back in technology, and we have the sell-off in the cyclicals. It doesn't seem to, there seems to be something missing here. I don't really get the action.
They're questioning, it's like I just said, so all of these speculative tech sectors, you notice they're all down 30, 40%, and some of them, those cloud names are down 50%. So that's a dramatic haircut. And I think people are finally starting to say, okay, how far is it up? When can you start attracting, number one, momentum players a little bit, but then even maybe some fundamental players who might be interested? They're not going to touch them at prices twice this high 2 months ago in the middle of February. Fundamental people don't care about that. But now when you drop it up, you start attracting people. I think that's starting to happen with some of these names like cloud, for example, 3D printing. Again, the bigger mega cap tech, they've held up a lot better, and they have fundamental investors.
Yeah. It'll be interesting to see how these stocks, the higher valuation names, do when yields go to 1.7, 1.8, 1.9. Bob, thanks as always. Okay. Tech stocks, meantime, have underperformed the market so far this year, but if you go back 12 months, the NASDAQ's still the leader in all three major averages, up more than 40%. Here's what investor Stanley Druckenmiller had to say earlier today about the euphoria in the market and how he is positioning.
I have no doubt, none whatsoever, that we are in a raging mania in all assets. I also have no doubt that I don't have a clue when that's going to end. We're still playing the game. We've shifted a lot of our relative bets into commodities, into interest rates, into the dollar. All those shifts occurred last say August through October, when it became clear to us that the recovery was going. But I will be surprised if we're not out of the stock market by the end of the year.
Wow. For more on the markets, I'm joined by Lisa Erickson, Senior Vice President and Head of the Traditional Investment Group at U.S. Bank, and Steve Milenovich, Managing Partner at Tech Advisor. Good to have you both. Steve, I'll start off with you since we are seeing this massive reversal in the tech sell-off that we had witnessed earlier today. Going to the point that Bob was making, that there is a haircut of about 30% on some of the highest flying stocks out there, the cloud stocks, et cetera. Is that a point in your view where you can go in and say that the price accurately reflects the fundamentals of these companies?
Yeah, Melissa, I would say it's still a little bit early. Just one example, about 20% of the NASDAQ stocks are at a 1-month low. Typically, you want to see that closer to 35% to reflect capitulation. So I don't think you have to be buying here. Large cap should hold up better, but remember, large cap stocks, for example, the XLK, has actually performed in line with the market the last 12 months. It's underperformed the last 6 as you had the rotation away from growth. Longer term, I still feel very good about names like Apple and Google and Microsoft. So if you're a long-term investor, you can probably pick away a little bit here, but it wouldn't shock me if there's a little bit more downside.
Yeah, are you surprised at the tech action, Steve, today, given interest rates ticked a little bit higher in today's session? We saw that massive, swing from down 2+% on the NASDAQ to basically flatline right now.
I'm a bit surprised. I'm not sure how much I'd read into it. I think, we could see further weakness. The IGV, which is the software index, yesterday closed right on its 200 days. So it is bouncing above that. We'll see if it holds there. I'd be a little bit surprised, actually, if it does. I was quite surprised last year when we kept talking about the most expensive tech stocks, mostly software names that are bouncing today, were the ones that just kept going up and up and up. And at some point, it didn't seem to make sense. So we're finally seeing the other side of that.
Yeah, Lisa, what's your take on the valuation of some of these cloud stocks, some of the software stocks, the ones that were really in the crosshairs when interest rates go up and investors start questioning valuations?
Well, absolutely. With the higher interest rates that we've had throughout year to date, as well as some pickup in inflation expectations, it is going to challenge some of these names where the growth is more forthcoming. But that being said, for tech as a whole, we feel very similarly to Steve that this is, if you look over the long term, a great sector to be a part of. There's certainly secular demands for continued usage of technology in many different formats. And so they are going to have some higher prices overall. And again, looking at the pullback we've had, it is an opportunity to, bring back some of those valuations to more reasonable levels.
Lisa, this is Courtney Reagan here. We haven't really talked about yet the chip shortage and how that impacts a number of stocks, not just in the tech space, of course, but across the board. If that continues, what companies might win if you've got demand outstripping supply?
Well, in general, we do see just a broad array of basket of technology stocks, including suppliers, essentially, as well as those who offer in services as attractive. And again, if we just look at what's going on with demand, what we see is there was already a trend towards really becoming a more digital economy overall. And really what happened in the pandemic, as we all know, is those trends just truly accelerated. And so that provides a very solid base, again, to hold a broad basket of stocks. And so we really are advocating staying put in those positions and, again, having a nice, healthy mix of stocks across the sector.
Steve, in terms of this rotation that we've seen more broadly in the markets from growth to value, we're also seeing that within technology. Names like IBM, Cisco, Oracle, they are doing well relative to some of the other higher flyer names in the tech sector. Do you like any of those sort of quote unquote value tech, old school tech names?
Yeah, they have been doing quite well, and they are very much represented by, quote, value tech. These are the names I used to cover. So Dell, I know when I covered Dell, it was like, boy, this thing is really cheap. And now they've spun off VMware, and it's finally, moving toward that kind of $100 price point. IBM, you mentioned. Arvind Krishna is doing some interesting work there, and even IBM's picking up. The HPs have acted well, though they're getting hit a little bit today. So today it's reversing. Legacy tech is down a bit, but you are seeing on-prem spending come back. So they're kind of the way to play tech on the opening because people are starting to spend on on-premise computing. At the same time, the cloud spending still looks strong. It's not like you're seeing tech companies missing earnings generally. I just think there's a bit of a PE contraction, rotation away, higher interest rates, and it just has to play out a bit longer.
All right. Good to get your insights. Thank you both, Lisa Erickson and Steve Milanovich. Courtney.
Well, children between the ages of 12 and 15 will soon start receiving Pfizer's coronavirus vaccine after a decision by the FDA late yesterday. That was a hot topic of discussion at CNBC's annual Healthy Returns Summit today. Meg Terrell joins us now with some of the highlights from the event. Hi, Meg.
Hey, Court. So that was a main topic of discussion with Dr. Rochelle Walensky, the CDC director. She said overall, she thinks vaccination is going well in this country, although they're getting to the point now where they have to reach folks who are not as eager to get the shot as the first group was. She said if we get to 70 to 80% vaccination rates in this country by fall, we should be in good shape. But some communities will have less than that. And she said those communities might still see outbreaks in the fall of COVID if they don't get their vaccination rates higher. For kids ages 12 to 15, she said she really hopes to see that a lot of them will get the shot. And I asked her what it could mean for schools. Here's what she said.
We should be in full school, full in-person school in the fall. We have vaccinated over 80% of our teachers and educators. In the fall, we will have, or I hope sooner than the fall, we'll have the opportunity to vaccinate our teens. And so I really am hopeful for a really robust, full in-person school year in the year ahead.
So she said it wasn't going to be necessary to go back to school safely. And she noted for younger kids, we likely won't have a vaccine at that point, although the companies are working on them. Another huge topic of conversation lately, of course, around the COVID vaccines has been the Biden administration's support for waiving intellectual property protections for the vaccines. I also spoke with Eli Lilly CEO David Ricks about this. They are not making a vaccine, but of course he is a leader in the industry. And Representative Alexandria Ocasio-Cortez, after that announcement about the vaccines, actually tweeted out a CNBC tweet about the COVID vaccine maker's stock prices and said, let's do insulin next. Eli Lilly is, of course, one of the major makers of insulin. I asked Dave Ricks his response to this. Here's what he said.
I think it's an unfortunate turn of events because, the representative you mentioned and others who were proponents of this, I don't think understand the issue particularly well. The problems in getting vaccines to the world are quite different and require a huge supply chain effort. I believe the number of vaccines for COVID we'll deliver in a year as an industry is double the normal vaccine production for all other diseases. So it's a huge operational lift.
And guys, he also noted that for insulin, there are already biosimilar competitors on the market, and it is a tough space to compete in. Court?
Thanks, Meg. I want to go back to some of the points you were making earlier on, talking about the hesitancy in some communities and trying to reach them with these vaccines, and then tie it back to them being approved for younger children. My brother-in-law works at a high school, and he said they had a vaccine drive for those that would be eligible yesterday or the day before, and only 14 kids showed up. Is this going to be a problem that's even more pronounced in a younger generation?
It could potentially be. There was a Kaiser Family Foundation poll, at least of parents, that came out last week saying 30% say yes, absolutely right away. For my kids ages 12 to 15, I want the shot. 23% said no, definitely not. But what Dr. Walensky told us is that they have seen hesitancy in adults go down over time. And so they're hopeful that for teens that will happen too, and that they'll see the benefits of getting vaccinated in allowing them to get back to their regular everyday lives.
That's so interesting, Megan. The insulin tweet was also fascinating from a Representative Ocasio-Cortez, and then the Eli Lilly's response saying, look, I'm not sure that they really understand what's going on. Has there been any follow-up? Do you believe that there should be a bigger conversation between the drug companies and the lawmakers because of the influence that a tweet like that could have to, perhaps move perception in the broader market of those that also may not have a deep understanding of insulin availability?
It's such an important question, Court, and it's been a battle that's been going on for so long. I'm not sure if the conversations are really happening on a real level. It seems like there's, shots across the bow from legislators to the drug industry. The drug industry says, you don't get it. This is really hard. And that's kind of where we leave it. We'll see under a Biden administration.
Meg, sorry to interrupt. We got to go to the White House. Energy Secretary Jennifer Granholm is speaking now about the Colonial Pipeline hack at the White House press briefing. Let's listen in.
Colonial return the pipeline to normal operation as quickly and as safely and as securely as possible. I would note that last night, one of Colonial's major lines resumed operation under manual control, while the existing inventory is available, along with some of the smaller lines that are spurs off of the major lines. They are getting those up and running. Many of you are aware that Colonial announced yesterday that they fully expect to substantially restore operations by the end of this week. Now, I've had several conversations with the CEO of Colonial, and who has indicated that by close of business tomorrow, Colonial will be in a position to make the full restart decision. But even after that decision is made, it will take a few days to ramp up operations. This pipeline has never been shut down before. It travels great distances. There is fuel in the pipe, and then there is fuel, the offtake from the refineries that have to be added. So it will take a few days to be up and running. But our interagency effort is going to be on it all the way. And let me tell you what that has looked like so far. Starting this weekend, my team began multiple daily calls with Colonial senior executives, Dave Turk leading those. And those calls have enabled us to share information across the federal government to keep us fully in sync with their progress and to let them know what resources we can bring to bear. We've spoken today and yesterday with several governors' offices in the affected areas from the South and the Mid-Atlantic. They're obviously, understandably concerned with reports of gas stations running out of fuel, and they want this pipeline restarted, as do we all. We are going to continue to assess impacts along the East Coast and in particular the parts of the Southeast, using the information and analysis from the Energy Information Agency, which is part of the interagency combined effort, and other federal partners. We're using these conversations and that information to inform the federal decision making with our federal partners around steps to mitigate these supply impacts and disruptions. So on Sunday afternoon, some of you are aware that the Department of Transportation issued an hours of service waiver, which provides greater flexibility to drivers who are transporting gas and diesel and jet fuel across 17 states, as well as the District of Columbia. DOT also moved to temporarily relax some of its workforce requirements and monitoring so that we can make sure that we have the personnel online in these places and with the drivers. This morning, the Environmental Protection Agency issued a waiver of the blend of fuels for the affected states to allow us to use non-compliant fuel and boost available supply where it's needed. Further, the Department of Transportation's Federal Rail Administration is working to enlist rail operators in an effort to transport fuel from ports inland to and from. And I spoke as well with Chairman Glick of the Federal Energy Regulatory Commission of FERC this morning. He is positioned to issue, FERC is positioned to issue orders quickly to direct the pipeline to prioritize fuel to the areas that are most in need once the pipeline is up and running. So in short, we're looking at every option we have across the federal government and all of the agencies. And in the meantime, I do want to say this, that we expect that gas station owners are and should act responsibly. We will have no tolerance for price gouging. Federal and state officials will be investigating those actions if they see price gouging, and we are urging consumers to report any price gouging to their state attorneys general. And still, I want to be clear that these states who are impacted, even with the turning on of the pipeline system, they still may feel a supply crunch as Colonial fully resumes. So, but the American people can feel assured that this administration is working with the company to get it resumed as soon as possible. And as one other warning, I guess, let me emphasize that much as there was no cause for, say, hoarding toilet paper at the beginning of the pandemic, there should be no cause for hoarding gasoline, especially in light of the fact that the pipeline should be substantially operational by the end of this week and over the weekend. So at the same time, it certainly is a reminder that we need to take a hard look at how we need to harden our necessary infrastructure, and that includes cyber threats. And as Ann Neuberger, who was here yesterday and told you, this administration is taking an all-hands-on-deck approach to enhancing our cyber defenses, and Secretary Mayorkas is here to tell us a bit about what he's doing on that front.
Thank you very much.
We were listening to Energy Secretary Jennifer Granholm saying essentially that a decision on when to restart the Colonial Pipeline will be made as soon as tomorrow. It could take a few days to get the pipeline fully up and running. And in the meantime, she warns Americans, do not hoard oil. Just like at the beginning of the pandemic, no need to hoard toilet paper, no need to hoard gasoline or oil at this point. Take a look at how oil is trading right now. We've been watching that all session long. It is slightly higher, up by about 0.5%. On the equity side of things, we were just a couple of pennies away from its 52-week high set on Friday, but energy stocks right now mostly lower. Coming up, retail is coming back. The XRT is up nearly 150% in the past year. If you want to bet on the retail revival, our next guest will tell you how to play it, so stay with us. Welcome back to Power Lunch. Let's get to Rahel Solomon for Market Flash. Rahel.
Hey, Melissa. Yeah, we want to take a look at the stunning reversal that Palantir has had. It was down as much as 10% before the bell this morning following its quarterly results. But take a look. You can see it is now up almost 8%, on pace to break a 10-day losing streak, its longest losing streak since going public last year. We should say despite today's move, it is worth noting that Palantir is still down about 15% year to date, 15.3% year to date, and more than 50% off its January highs. Courtney, I'll send it back to you.
Thank you very much, Rahel. Now let's move on to retail, which also under pressure today, along with the rest of the market. But so far this year, the retail ETF is still up about 40%. And some of the companies that struggled during the pandemic, like L Brands and Gap Inc., have actually seen some nice gains as consumer confidence begins to soar. So what's in store for retail going forward? Well, let's bring in Ike Borshow. He is the managing director at Wells Fargo Securities. And he says, let's stick with retail brands over discount stores when you're talking about investments. So Ike, I want to start with you because we mentioned L Brands there, and we have some news that they are going to officially spin out Victoria's Secret, something they had largely telegraphed before, that it would either be a sale or a spin out. So how are you looking at L Brands then as it exists with just Bath and Body Works? Is that a buy? Is Victoria's Secret the buy? How do we evaluate a stock like that?
Yeah, I think it's a good question. I think right now, L Brands, you're getting both of them, and they're both great stories. Bath and Body Works is one of the best performing, if not the best performing specialty retailer in the space, both margins and comp sales. And Victoria's Secret, I mean, ever since the Sycamore deal fell apart around this time last year, the management team has done a phenomenal job. I mean, they tried to sell that business for $1 billion last year. They're going to spin it out. And I mean, we wrote in our note today, we think $5 billion is very much on the table, if not more. They've done some phenomenal things there. So there's still a lot of hidden value for LB for sure.
Okay. And then we also mentioned Gap in the intro, and that you like brands here over a discount retailer. But Gap had been so beaten down. They have a CEO that's still relatively new and still making some new decisions. They're finally sharing some numbers about Athleta, which really seems to be a growth driver for them, although it's much smaller than the main brands. Is Gap a name that you're still watching here? I mean, of course it's higher. It was so beaten down before. So is it a name you like on fundamentals, or just because it's got room to run back up?
Yeah, it's still one of our top picks. I think if you look at our top picks in the space, whether it's Capri or Gap or L Brands, I mean, there's a lot of hidden value in these names. And you mentioned Athleta, and I think that what the market missed last year was just understanding how much value Athleta has, how much value Old Navy has, Gap being, called a liability. But remember, Gap is being turned around. They've got some interesting things on the horizon. They've got the Yeezy collaboration coming up. There's a call option with Gap there too, Gap brand. So I agree, the specialty guys and the brands, they've been outperforming the discounters. I mean, they're up 80% since November. The discounters are up 25, 30%. So we would stick with that. We still like the off-pricers long-term, multi-year, but the stories are better for the brands and the specialty guys right now. There's just more upside.
Like we talked, you and I, about PVH because today is CEO Stefan Larsson's 100th day as CEO. And they sell, of course, names like Tommy Hilfiger, Calvin Klein through their own product chains, but also through licensing deals. And they sell at off-pricers as well as department stores. How do you evaluate a name like that? It's a brand, right? But it sells at many different retail formats.
Yeah, look, I mean, Stefan Larsson, he's done some great things in his career. He was doing some great things at Ralph Lauren. He did great things at Old Navy. It's still a little early to see ultimately what his multi-year view is on the business. They have an analyst day that's coming up soon. He wants to focus more on data and digital. That makes sense to us. He wants to focus on distribution, cutting the tail end of inventory off. That makes sense to us. These are a lot of the playbook. This is the playbook from Ralph. That makes a lot of sense. For us, we just prefer some other brands in the space, like we mentioned, Capri, Tapestry, Ralph. Those are more the names that we're trying to ride. But PVH, to your point, has also been on the glide path up as well.
A lot there for retail investors to chew on. Thank you very much, Ike Borshow, for joining us here today.
Thank you.
Well, we'll continue to watch these markets. The Dow is down nearly 500 points. Dow laggards, Home Depot, Boeing, American Express, and the tech crunch continues. NASDAQ laggards, eBay and Intel are in focus. Power Lunch, be right back.
Welcome back. I'm Rahel Solomon, and here is your CNBC COVID update at this hour. President Biden meeting virtually with a bipartisan group of governors to discuss best practices for the COVID-19 vaccines. This is the average daily number of new COVID cases in the U.S. fell below 40,000 for the first time since September. The chief science officer for the White House's COVID-19 response team telling lawmakers that COVID-19 booster shots will also be free to the public. David Gessler says that it's still unclear whether the booster shots will actually be necessary, but that the U.S. is preparing in case they are. And Broadway coming back. 3 of Broadway's cornerstones, Hamilton, Wicked, and The Lion King, set to kick off the reopening on September 14th. The news comes a week after New York Governor Andrew Cuomo said that Broadway theaters will reopen just after Labor Day at full capacity. And tonight on the news with Shepard Smith, the former head of the American Medical Association, will discuss what the return to normal means for mental health, as well as tips on how to cope. Tips I'm sure many of us could use. Melissa, I'll send it back to you.
Absolutely. Rahel, thank you. Rahel Solomon. Time now for today's Power Movers. Novavax shares down 14%, down as much as 20% at one point in the session. The drug maker delaying timelines for seeking regulatory approval for its COVID vaccine. On the positive side of this market, U.S. Steel getting an upgrade over at Morgan Stanley. This is steel prices near all-time highs. Shares are up almost 4%. Finally, BMO upgrading Activision Blizzard, saying selling pressure has run its course. It is up by 2.5%. For more on today's big calls, including Activision Blizzard, check out cnbc.com/pro. Court.
Well, coming up on Power Lunch, fund fight. It's old school versus new school. One Wall Street oracle against the other. Cathie Wood and Warren Buffett seem to disagree on a lot, especially when it comes to Apple. We'll explain. Plus, one group getting crushed recently, electric vehicles and battery stocks like Tesla, Fisker, and Blink Charging down big. So will the sell-off continue? Well, Power Lunch returns after this, and we'll talk about it.
Welcome back to Power Lunch. Markets right now off the worst levels of the day. It's almost like a mirror image of what happened in yesterday's session. Yesterday, the Dow held up pretty well. Today, the Dow is down by 1.6%. S&P 500 right now down 1%. The NASDAQ is pretty much flat, which is a remarkable reversal considering the lows of the session were down 2+% or so. Russell 2000 is down fractionally. Take a look at oil closing for the day. Crude is up 0.5%. Let's get to the bond market right now. Rick Santelli's tracking all the action at the CME. Rick.
Melissa Lee, Jolts this morning, 10 o'clock Eastern, 8,123,000. You see the chart there. This number started 21 years ago, and it's never been above 8 million, a big number. And if you look at an intraday of 10s, after that number was released, we have not slipped under 161, which is an important level for the close. Bond yields, for a while, they were hovering at minus 15 basis points. They settled at minus 16, but 1 basis point made a lot of difference. They settled under or above, I should say, a minus 16, a less negative number. It would have been the highest yield close going back to 2019. So 2 years. Dollar versus the Chinese yuan. Well, yesterday it touched a 3-year low and it had a meager bounce today, as you see on the chart. And finally, the pound versus the dollar standing at a 3-year high. So we see pressure in the dollar index. And of course, we all know that this morning, Stan Druckenmiller talked about how many of the policies are going to play havoc with the value of the greenback. We're already seeing some of that at this point. Melissa Lee, back to you.
Thank you, Rick Santelli. Let's get to Rahel Solomon for another market flash. Hey, Rahel.
Melissa, I feel like I was just talking to you. Hello. Yes, hello. Take a look at some of the electric vehicle and battery stocks right now. So after beginning the day firmly in the red, many have rebounded. Talk about a reversal, though Tesla remains a lagger. You can see it's still down 1.7%. Plug Power up, however, 16.3% now. Important to note, most of these stocks have already had a tough year, with Plug Power, QuantumScape, and Lordstown among the names that are 70% or more off their recent highs. So, guys, we'll have to see whether today's move is the beginning of a turnaround or perhaps just a brief pause in the selling. Melissa.
Rahel, thank you. Joining us now is Gabe Dowd, Cowen Managing Director for Sustainability and Energy Transition, and Edison Yu, Deutsche Bank Auto Research Analyst. Great to have you both. We have you on because we want to get your take on this crush. And Gabe, I think the key question here is what has changed? Has anything really changed aside from maybe the interest rate backdrop to this? For instance, let's take QuantumScape, which reports after the bell today, and you cover that stock. It's down 77% from its highs. Should the stock ever have been at those highs? What is behind this decline?
Yeah, Melissa, it's certainly a good question. I think you could argue the EV complex overall year to date has certainly had a tough year. The basket of charging and battery stocks are down 30 to 40, 60% plus year to date versus the S&P up 10 to 12%. I think there's just a lot of enthusiasm that's come out of the stocks this year. There's overall plaguing the auto industry, the chip shortage. You have an increase in commodity prices like copper, steel, aluminum that could potentially put pressure on the margin side. These stories always were longer dated investment cases that really take hold over the middle part of the decade and beyond. Which could be beyond anyone's realistic investment time horizon. So I think you're seeing a lot of that enthusiasm come out a bit, but like we've said recently, we think the longer term stories are largely intact. In March, EV sales were highest on record, and in 1Q of this year, as a percentage of total sales, EVs was 6%, which doubled year over year. So I think the trends are still in place.
When I hear enthusiasm, Gabe, I think froth. Do you really mean froth? That some of the froth has come out of these names?
Enthusiasm, froth, tomato. You could argue like the valuations are certainly a bit stretched coming into this year. And again, a lot of the stories are really plays on longer term themes, but we think those themes are in place. And yeah, so maybe you did see just a little bit of the multiples compress a bit. But like I said, I do think the long-term theses are in play, are intact.
Edison, you cover the Chinese EV makers, and so I'm wondering what your take is over there. I mean, is their fates dependent on the success or failure of Tesla in the Chinese market?
Yeah, so thanks for having me on. So I would point to two things specifically on China EV, and it's sort of classified, I would say, in one bucket as competition, and the other side would be a rotation. The competition in the Chinese EV market is by far the most intense of any geography. If you look at the Shanghai Auto Show, there's literally every tech company in China coming up with an EV. Some of them are partnering up with local competitors, and they're releasing models fairly soon, some less than a year away. And so the competition that's coming has created a lot of anxiety among investors. And this is translating into fairly weak stock sentiment. The other issues I would say are a little bit more tactical. If you actually kind of just look at the market cap of NIO, XPeng, and Li, and you can even throw Tesla in there, and then you compare it against the traditional automakers. So, GM, Ford, Volkswagen, Daimler, etc., Hyundai, you can actually see there's been a big rotation from the new upstarts to the traditional incumbents. And I think that's a reflection sort of competition, but a different sort, which is the existing OEMs fighting for their lives and actually putting forth very credible plans for an EV future and investing tens of billions of dollars. So I think you throw those two factors together, and then you had 2020, which was a year where all these stocks went up like crazy. It's kind of how you end up right now.
Yeah.
And then, we'll see what happens. It's a battle. I think it's truly a battle going forward.
Yeah, certainly GM, for instance, has really won a lot of favor for their EV portfolio. Gabe, last question to you, and unfortunately we're almost out of time here. But when you take a look at your space, a name like QuantumScape, and I hate to pick on them, but they are reporting after the bell. They were the target of a short seller report. It, and it wasn't the only one, recent de-SPACed company, at least 3 de-SPACed battery technology or EV companies were the targets of short seller reports. And I'm wondering if there was a certain amount of, tourist money going into this sector, because this is a sector, particularly when it comes to battery technology, it's harder to understand. I mean, it's not intuitive. There's a lot of complicated things going on. It all sounds great and it may be the wave of the future, but in terms of understanding the actual technology and what companies have right now, they're easy targets too for shorts.
Yeah, Melissa, it's definitely a good question. As you mentioned, battery conversations could certainly be quite dense for investors, particularly when we get into the chemistries around solid state and the potential there. Obviously, solid state has been or has showed promise before, and so investors, I guess, are questioning if this time is really different. And I think that, again, the issue with QuantumScape is the technology looks impressive and attractive, but it's still quite a ways away until commercial applications. Or you're seeing the technology in vehicles on the road. And the company's been upfront about issues potentially with manufacturing and scaling the technology. But again, with first revenue not really expected until 2025, you could argue for shorts it's an easy one to pick on.
Yep. All right. We will watch the earnings after the bell today. Gabe and Edison, our thanks to you. Great insights. Courtney.
Thanks, Melissa. Well, coming up next, tech under pressure. We've been talking about it. So which names should investors buy on the dip? Our traders will explain. Is Microsoft the best bet? We'll have to talk about it. Plus, as we head to break, take a look at some of the other parts of the market that are getting hit. Industrials like John Deere, Caterpillar, and GE are in the red. And check out some of the names reporting earnings after the bell, in addition to QuantumScape like EA, Fubo, and Lemonade, all higher ahead of results. Power Lunch will be right back.
Welcome back to Power Lunch. I'm Seema Modi. Check out the NASDAQ 100 attempting a reversal today after being down more than 2% at its lows, but roughly half of the components still in correction or worse. Some of the hardest hit names, Zoom, Peloton, Splunk, and Baidu, down more than 40% from recent highs. So let's bring in the Trading Nation team. Bill Baruch of Blue Line Capital, Nancy Tengler of Laffer Tengler Investments. Nancy, if you could pick one name here to buy on a pullback, which one would it be?
It would be Microsoft, Seema. Thanks for having me. This is not March of 2000 when the 10-year was at 6.5% and we were at the end of a business and earnings cycle. In fact, tech CapEx is now about 50% of total CapEx. So we want names that are going to participate and benefit from that. Microsoft has sort of been trading sideways in line with the market this year, but grew revenues at 19% last quarter and raised guidance. We like revenues because they're a fact. So this is a company we want to own for the next 3 to 5 years, or you want to buy for your grandkids. No hurry. Take your time. It's 10% off its 52-week high, and I think you have time in here to just pick away at the stock.
Bill, I know technicians like yourself are searching for the bottom. So from a technical perspective, are there any names here that you think are poised for a rebound?
I promise Nancy and I did not plan this. I chose Microsoft here too for a number of reasons, but I want to start off saying there's a thematic divergence taking place here right now in the markets, and everybody's been talking about it. We've been writing about it since the fourth quarter, and rising rates are going to be a headwind for tech. I'm much more selective than I was in tech a year ago or even before the pandemic, and I think you have to continue to be that way. So we had this breakdown in the NASDAQ recently. It hit a trend line from the November lows, and the market's responding. I'm watching for the NASDAQ futures to close back above 13,350 today, and that would be a green light higher. As for Microsoft, and ahead of earnings, they had a tremendous run. We trimmed our positions in half in Microsoft ahead of earnings. I'm simply putting that back on here today. It's a very technical stock. It hit a trend line, Microsoft did, from the March lows here today at about 240. So I think that's going to be a big support, and we're going to see a rise here from there. I like Microsoft, and I think that's going to be a leader.
Some consensus on the panel. Bill and Nancy, thanks. And we also discussed the airline sell-off on tradingnation.cnbc.com. Be sure to check that out online. Melissa and Courtney, back to you.
All right, Seema, thank you. After the break, the battle over Apple. Kathy Wood selling shares. Warren Buffett says selling is a mistake. Who is right about the future of Apple? We'll debate that.
And now, the latest from tradingnation.cnbc.com and a word from our sponsor.
Generally speaking, a strong dollar is good for the economy, but that doesn't mean that all companies are going to benefit equally. In fact, companies that do a lot of business abroad and those that are in manufacturing tend to be more vulnerable to a strong dollar. So if you believe that the dollar is going higher, you might want to check your exposure to these types of companies. I'm Joanna Payne, and Schwab is the better place for traders.
Welcome back. Let's get to guess who? Rahel Solomon from Market Flash. Rahel.
Hello again, Melissa. Yes, we wanted to take one last look at the home construction and improvement players firmly in the red. All 5 stocks on your screen. We're all trading at all-time highs yesterday, clearly pulling back today. In fact, Pulte Group and Lennar even started today at fresh highs before things turn south. You can see Pulte is down about 4.2%, let's call it, and Lennar is about 3.6%. Now, Melissa, you mentioned this at the top of the show. Home Depot, a particular interest. It's the worst Dow component today, currently pulling about 70 points from the average and on pace for its worst day since November. You can see it's down about 3%. Courtney, I'll send it back to you.
Thank you very much, Rahel. If we had more time left in the show, we'd see you again. But let's talk Apple now. The stock has lagged this year, down nearly 6%. The Oracle of Omaha, Warren Buffett, and the so-called new Oracle, Cathie Wood of ARK Invest, are of different minds on this particular stock. Cathie Wood recently selling some of her Apple position, while Warren Buffett said he regrets selling some of his holding. So who's right about the future of the tech giant? Dan Ives is managing director of equity research at Wedbush Securities, and Tim Higgins is a tech correspondent with the Wall Street Journal. Dan, I'm going to start with you. I think you probably agree with the Oracle of Omaha on this one. Why is Apple overweight, in your opinion?
Yeah, I mean, I couldn't agree more because to me, it's about the monetization. Right? And I think they're just starting on the services side. That monetization story, we think that's worth 1.3 trillion alone. And we've talked about the super cycle. This is not just a 6-month super cycle. It's a 12 to 18-month super cycle. And we believe this is just a near-term pain that we've seen with the re-rating. But we ultimately think on the other side of this is a stock that's up 40 to 50%, 3 trillion in the next year. That continues to be our call, and we do not waver from that.
And Tim, I think you feel like perhaps there is some short-term risk. Maybe Cathie Wood is on the right side of this one. What are your thoughts here?
Well, I think that an investor like Cathie Wood is looking for stocks that are going to be parabolic. She's making huge bets on technology she thinks can disrupt the world. And when she looks at a company like Apple, that's not disruption in the future. It's more of the same, which is a very solid business, but it's not going to the moon, and she's looking for rockets.
Right, of course. So perhaps if you look at Apple, Tim, it's a stock that you could buy and you could hold for some time. I mean, is this a stock that you hang on to and pass down to your kids then?
That's what's been very successful for a lot of people. But if we're looking in this kind of short-term era where people are looking for speculative bets, Apple's not a very speculative bet at this point. It's a known winner for a lot of people. And so if you look at the way that she has viewed Apple in the past, and that's a place to safely put money until she wants to put it back in the table into bigger bets. And so if you're in the short term, you're probably looking someplace other than Apple.
So, Dan, as you look at Apple's universe, there are so many things that we could talk about, but services is certainly an area of focus for the company. How valuable is that, and how important is it to the trajectory of the stock? Probably not parabolic, but I imagine an important component.
Yeah, and Tim hits great points, but I think that's the linchpin. And it's been a big part of the re-rating that we've seen in the stock over the last year. If I go back a year ago, I think many on the street looking at 250 billion, I believe that's worth 1.3 trillion. And some of the parts that combined with what I believe is the biggest product cycle we've ever seen in Cupertino, they'll continue to prove the doubters wrong. And that's why I view this as a near-term, move down that ultimately is the golden buying opportunity from my long-term view. That's why I couldn't agree more with the Oracle Omaha.
And so, Tim, when you followed Cathie Wood here, and she's, of course, gained a lot of notoriety in the last couple of months, though, of course, she's been around for some time. Are there other stocks that we should be focusing on in her fund that trade along with or in opposition, perhaps, to Apple?
Well, I think there's a lot of attention. She's won a lot on her bet with Tesla, and that's been the challenge for her this year as you look at her returns, is that companies such as Tesla, they are a growth story, and there's questions about growth this year. And so, we're looking very closely at Tesla at this point and some of the other companies in that kind of genre.
Absolutely. Well, Tim and Dan, thank you very much for joining us here today to talk Apple and tech.
Thank you.
All right,
Melissa.
so of course we're watching this big tech reversal. It's still holding firm, although the Nasdaq is slightly negative right now, down by about 0.1%, quite a ways away from the session lows of down more than 2% here. We're looking at almost session highs for the names like Netflix as well as Amazon. Some interesting price action there. As for the Dow, it is down by 1.4%. The S&P 500 down by less than 1% at this point, really being weighed down by financials as well as industrials. Courtney, great to be with you. You hear the birds chirping. Go enjoy.
Power lunch.
Thank you, Melissa and Courtney, and welcome to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost at the New York Stock Exchange.
Interesting.
Here on Wall Street on this Tuesday afternoon.
Interesting day today. Yeah, for a while. Still keeping an eye there on the market, and my portfolio is still doing well. So just
Outperforming for a change after a blistering recovery off the lows of the day. It had been down as much as 2.2%. Climbed all the way back into the green at one point. So names like Tesla, Rackspace, Affirm, all seeing outsized declines. On the data front, job openings hitting a record high in March, more than 8 million postings, pointing to a continued struggle to fill open positions. And the volatility index is jumping today, touching its highest level in 2 months. Investor Stan Druckenmiller warning of a raging mania in assets earlier on CNBC. We will discuss 59 minutes left to run the session. Energy is the sector that is seeing the biggest decline today for a change.
Coming up on today's show, St. Louis Fed President James Bullard joins us exclusively to talk about the recovery in central bank policy. And it's the perfect day to have him as inflation fears remain a primary concern for investors. Plus, Sartori Fund founder Dan Niles joins us to discuss the big swings in tech stocks and whether he's been buying the dips. And a wild ride for Palantir investors today, the stock plummeting on earnings, but seeing a dramatic turnaround, now firmly in the
jumping here into another rec, but
to a shareholder
man, what an interesting day.
really typifies the turnaround today in tech stocks.
The crypto.
Let's get straight though to today's volatile market. Mike Santoli is tracking the action
Little
for
bit.
us, and joining us to break it all down is Wharton professor Jeremy Siegel. But Mike, set the stage for us first of all.
Yeah, well, obviously a pretty good
So doing pretty good, guys. Let's hold on, see if we can finish out this day. Just a little bit. Last hour, I think there's a good chance we actually more so than we've already done. At least the Nasdaq finishing in positive territory. I mean, I expect to see the Dow and the S&P go up as well. I'm not saying I just want those to go down and the Nasdaq up. The only reason why I feel like the Nasdaq goes up a good bit for investors like me is because then it doesn't oversaturate the rally that the Dow has had over the past 3 months. It balances correctly. So if the Nasdaq comes up, my stocks will fall, which is great. Like a lot of other people, retail investors like me that have invested in some of these fundamental stocks in the last year would benefit from that as well, while kind of stabilizing it against the Dow gains over the past 3 months. So hopefully that results in a stabilization and correction between the two investments. And then we can honestly move forward at a reasonable pace. So anyway, I'm going to jump in this room and swap and get some
premium that was built up during the pandemic and thereabouts, and you're back to where we were basically 3 years ago. Still more expensive. Nobody's saying it's dirt cheap compared to the overall market, but you've kind of come more into parity with where we've been on a longer term trend in terms of the big mega cap growth stocks compared to the S&P. You can decide whether it means everything's expensive or in fact it means that the mega cap growth is now looking more attractive. And also growth versus value. Everybody fixated on this relationship. This is a very long-term look at it going back almost 30 years. And so people point to this right here. After the peak in 2000 of the NASDAQ bubble, you saw growth underperform for years and very dramatically. So that meant value stocks were the better place to be. So is this kind of a similar ride? Are we going to see something like that multi-year outperformance by value? Look, maybe. But I would point out most of the work over there was done by a 60% peak to trough decline in the Russell 1000 value. I don't think most people who say value is a great place to be are saying, maybe it holds up and goes down less than 60%, and that's why I like it. So I do think it's a little bit of a more complicated situation. Maybe this goes like that because we do have growth that's more profitable today and arguably better positioned than it was in the year 2000, guys.
So one of the reasons that gets blamed for this big sell-off we've seen in technology and now that's trickled into the rest of the market is inflation and this debate about whether it's going to be sharp and whether it's going to be sustained and whether the Fed is going to have to do something about it. How does that impact the valuation conversation that you just laid out?
It's definitely pinching things. I mean, we haven't seen valuation expand for months. It's absolutely in the air. And I think that the problem is, I mean, if we want to call it a problem, is investors are going to be looking at these hotter inflation numbers one way or another. And either A, it means that the Fed is not going to be able to stay as generous and it's going to have to pull forward its timing for when it gets tighter. Or maybe more likely, the market's just going to have to deal with the uncertainty of whether this is, transitory inflation or it's going to be here to stay, and that might hurt, valuations on an ongoing basis. So that's, I think, why you have a push-pull right here. Treasury yields, they've held up. They didn't actually go down when the market was at its lows earlier. So it seems like we're all positioned and bracing in advance of this blow, which may or may not come. Let's keep that in mind.
Mike, thank you for that. The Nasdaq, as we said, off its earlier lows. The Dow still down to the tune of 1.4%. Let's bring in Professor Siegel, as we mentioned earlier, Wharton School of Business Finance professor. Great to see you, Professor Siegel. I was reading some of your notes. You said that you welcome the rotation. I guess you were meaning the rotation that has been dominant year to date, i.e. value over growth, as opposed to the sort of bounce back intraday of growth over value.
Yeah, I mean, that's quite a turnaround. I don't think the rotation is over. I believe value will outperform growth. And don't forget, really, you have two tiers on growth. As Mike said, I mean, most of the NASDAQ is not unreasonable. It was just there's a number of those stocks that are selling not at 100 times earnings, 100 times projected revenues. They're the ones that are hurt as much. And I don't think their reaction is over. But nonetheless, I still think the reopening trade is going to be the winning trade this year. I still think there's tremendous support for the stock market, and it's still going to be going higher from this point.
If, Professor Siegel, we do see inflation surprise significantly to the upside either tomorrow or in the months ahead, do you think stocks will correct? And do you think that would be a buying opportunity or a legitimate correction?
Well, I think if they correct, I would be buying opportunity. Don't forget, stocks are claims on real assets. And firms are having no trouble passing on these extra costs they're getting onto the consumer. Look what's happening to profit margins. We may get the highest profit margins in history, the highest beats versus expectations in history. So I'm only worried when the Fed really going to tighten, and it could be at the end of the year. I mean, I listened to Stan earlier on the program. He said he'd be out of the market at the end of the year, and I was sort of wondering, well, it depends on where this market is. I mean, if the stock market's up another 30%, I think I might be really shading down on stocks. If it is where it is today, I'd still be in it. So I still think there's a good deal to go. I'm not worried about early inflation. I'm worried later inflation, the Fed tightening, but we could be much higher by that point.
So what does it mean ultimately, Professor Siegel, for growth stocks? I mean, if you look at the past decade, it's been dominated by themes like online shopping and cloud computing and digital everything services. Yes. And that's been the place to be in an era of low interest rates. So what happens next? Is that trade over?
Well, I think it will trade over. You also have to remember that really interest rates after inflation are the most important consideration. So I don't think I'm going to be too worried. The Fed raises to 2% if inflation is 5%. That's still, free money to individuals. So it has to go up more, and that's usually at the very end of the tightening stage of the Fed, not in those early years of tightening. So I don't think the challenge is earlier, although the mindset is as soon as the Fed begins to taper, there will be a ripple in the market to be sure. But the real bite won't come until they really stop inflation. That might not be till 2022, maybe even later that year.
What's the 3 to 5 year view for U.S. equities, Professor Siegel? Is this a screaming buy, or do people have to be nimble with the months ahead?
Well, I think it's a buy this year. I think we've got another 10, 15, 20%. And then I think we're going to be into a lower return regime. And I think people are going to be looking for value for dividends because fixed income is just not going to keep up with inflation. History has shown, all the research has shown that dividends on stocks do keep up with inflation. And that's another reason why I think the value trade will be a good trade in 2021.
Jeremy Siegel, thank you for joining us. Wharton
Thanks
professor.
for having me.
We'll have much more on the market throughout the show, of course. And coming up, investor Stan Druckenmiller weighing in on the recovery and the Fed earlier on CNBC.
I can't find any period in history where monetary and fiscal policy were this out of step with the economic circumstances. Not one.
We will ask St. Louis Fed President James Bullard if the Fed needs to change its course sooner rather than later in light of the recovery. The Dow's down 490 points or so. We'll be right back. You're watching Closing Bell on CNBC. Dow's down about 500 points. Increased inflationary pressure weighing on investor sentiment. Is it time for the Fed to adjust its policy? St. Louis Fed President James Bullard joins us now for an exclusive interview. Welcome back to the show, President Bullard. Good to have you.
Glad to be on.
Inflation is the question du jour, and it is causing a lot of angst on Wall Street right now. How do you interpret these moves we're seeing in commodities and inflation expectations that's spilling over to the NASDAQ and now the broader market?
I do think we're going to see more inflation in 2021. I'd say maybe 2.5% to 3%. Reading it right now, we're certainly hearing a lot of anecdotes from our business contacts about supply chain disruption and other increases in prices, commodities, as you just mentioned. So I think we are going to see some inflation. Then I expect some of that to hang on in 2022, maybe 2.5% in 2022. So part of that is the Fed's strategy of being less preemptive than we would have been historically, because we're trying to make up for past misses of inflation to the low side of our inflation target.
So it sounds like you're in the transitory camp. I'm trying to feel out where you are on the transitory scale. How likely is it that the Fed would have to move?
It's a good question. So transitory, but not all of it, because part of what we're trying to do is get inflation expectations cemented at the 2% target. They've been slumping down below target over the last decade, and we want to reinforce our inflation target. So we want to get inflation expectations up. 5-year break even has been trading somewhat higher here, but not at such a high level that I'm worried about it. But I do think we will be able to get inflation up and over 2% over the next 2 years and allow it to be there for some time.
How big a swing factor, President Bullard, for the level of transitory nature of inflation is vaccination rates? And if we get above expectations, does that suddenly mean we're in a worrying outlook for inflation?
The vaccination process seems to be going pretty well. I would say a good baseline model to have in your head is a technology adoption model, which is always S-shaped. Whenever you see those curves, they're very slow at the beginning, then they rise rapidly, and then it's very hard to get the last part of the technology adoption. That's what's going to happen with the vaccinations here. But nevertheless, I think it's going very well in the U.S. Fatalities are coming down dramatically. Confirmed cases are down dramatically. So I think that bodes very well for the U.S. economy and our ability to reopen and put the pandemic behind us. Not as good in the rest of the world, as you know, but going very well in the U.S.
Which brings us to the jobs question. Today, we got data showing 8.1 million job openings, a record high. We've started to see wages move up, so there's clearly demand for labor, and yet April's jobs report was disappointing in terms of the number of hirings. Why do you think that happened?
I think it's just a little bit early to really expect a big jobs growth. You've got the pandemic not quite over yet, not everybody vaccinated, still at risk out there. It strikes me that for a low-wage worker that's been disrupted, it's not that great a proposition right now to tell that person or ask that person to come back to work. So I think we're still in the woods a little bit here, but that'll all clear up. This economy is growing very, very rapidly, well above trend growth in the first quarter. It looks like the second quarter, people are talking 8 or 9% at an annual rate. For all of 2021, I think we'll see very rapid growth.